Good morning. Saturday, July 2nd. Here we are, new quarter. Song remains the same. Nothing's changed. People sending me DMs and questions to George. Have you changed your mind? Do you think the market's bottoming? When are you going to turn bullish? I don't know. Nothing's changed. Well, actually, it has. It's gotten worse. The only bull market I see is the bull market and people trying to call the bottom. The investing public still hasn't gotten the memo. They've yet begun to sell in earnest. And I think we've got a long way to go. People can try to talk about sentiment all they want. And there's wild misuse of sentiment data. People cherry pick the surveys that they want to focus on. Various prime brokerage firms send out their, prime brokerage departments send out their own surveys of exposures and whatnot. And the fact of the matter is, if you look at hedge fund exposures, that's what I like to point to the de-risking. It's only back down to where it was maybe 10 years ago. Yeah, it's lower than it was in the last 3 or 4 years, but you'd expect everyone to be, maximum invested in against the backdrop of the most irresponsible monetary policy in recorded history. But if you zoom out a little bit, and if you consider that, if you want to say, okay, 45% net long is a new flat, okay, fine, everything's fine. So yeah, professionals are de-risked to some degree, but they're still getting destroyed. Just look at the year-to-date performance figures for hedge funds. Individual investors have hardly sold anything. Hope Shrub comes in the room today. He's always got the weekly flow data. I have it somewhere. The stuff that comes out from Merrill Lynch does. Bank of America Merrill Lynch does a great job with that. But it's the selling they've done is minimal compared to the trillion plus they put in the market last year. And as we've been constantly discussing in these rooms, I mean, these are things you don't see at a bottom. And so I think you have a situation is really one of you have a bunch of fully invested bears in a time when liquidity is evaporating. And we haven't done a room. It's been 8 days. The last room we did was with the great Julian Brigden, who I see is in the room today, and I hope Julian will weigh in with maybe some of his updated views. He's had the playbook. He's been right as rain. And it's getting hot and getting hotter. I'm kind of curious and see if Julian's got any updated views on his view of the July CPI number. So the song remains the same. Inflationary pressures, okay, if we get a recession, fine, they'll abate, but will they come down sufficiently to the point where the Fed can really ease? Who knows? Anyway, market's not cheap. I think we're on the cusp of earnings collapsing, just collapsing. We've got a bear market in margins. Profit margins are well above trend. Liquidity's evaporating, and the public's all in. What could possibly go wrong? Or more appropriately, what could possibly go right? I was out yesterday, so I didn't have a chance to look that critically at the market action. We've got a good friend, Tom Thornton, who's a good friend, one of the sharpest cookies out there, a good friend of this room, proprietor of Hedge Fund Telemetry. It's a product that I read every day, and I suggest all of you do as well. And I'm sure if you reach out to Mr. Thornton, Tom will take care of you. I don't know. We'll have to come up with a new discount code for this weekend, Tom, a July 4th special. Again, I have no commercial relationship with Tom. I just try to point people in the direction of market analysts and sages who I deem know what's going on. I just look at this room right here. It's unbelievable. I mean, just look at this room. There's I keep saying it sounds very self-serving. We have the best spaces on Twitter. No, we do. Look at this room. Just look at it. I'm just going to, not in any order, the order I see them appearing on here in the top row on down. We got Thornton, Brigden, Shrub, Three Aces, KFAB. I mean, I can just keep going. It's just sick. I see we have my friend Stefan, and we got Carpathia, and Bob Klein, Stefan. I mean, this is just, you guys don't have to come here to listen to me. It's just, we have first mover advantage. This is where all the smart guys hang out. Anyway, enough of that. So that was a hell of an end of the month, end of the quarter rally we had there. So now we're back to our regular scheduled programming. And again, and you'll correct me, Tommy. I can't remember if it was Jesse Livermore who said it, but it's not being on the bull side or the bear side of the market that counts. It's being on the right side. You just want to call them like you see them. I know many people think I'm a perma bear. I do have glass half tendency and glass half empty tendencies. I won't dispute that. But my public profile in terms of in FinTwit, I've only been out there for a year or so, and started on these spaces back in December. And yes, I've been unashamedly and uniformly bearish. It's not my disposition necessarily, but I call them like I see them. And when the weight of the evidence turns otherwise, I will change my mind. I was making a presentation to somebody the other day, or I was having a discussion with someone actually, and I put a line down a sheet of paper and just positive, negatives in anything you look at, strengths and weaknesses, and you try to examine the weight of the evidence. And one of the things I found really arresting was I just made a list of who I deem to be the smart guys and what are they saying. And whether it's you, Thornton, and I'm not trying to embarrass you, it is what it is. You or Julian or Aces or Shrub or Michael Belkin or Michael Kantrowitz or John Roque, or the list goes on, Larry Jetalo, Michael Howe. It's like, who do I turn to when I lose my bearings? Who do I look to for guidance? And I just wrote down, what are these people saying? And of the sort of 8 or 10 guys I read that I respect, they're all saying the same thing. Mostly the same thing. Now, before someone says, oh, George, contrary opinion, you're in your own echo chamber, and see, everyone's bearish, so it's time to be bullish. Julian, I think I'm using the word correctly, bollocks. This is a very obscure, small sample set of financial perverts that's meant as a compliment. People with variant or deviant perceptions. This is not the crowd. The crowd is CNBC. The crowd is Jim Cramer. The crowd is the street telling you to, stay the course, stay with 60-40 portfolio. Can't sell, can't time the market. If you time the market, if you sell, then you got to figure out when to get back in. If you sell, you're going to have to pay taxes. That assumes you have any gains left on which to pay taxes. Or my favorite one, if you sell, it's going to mess up your asset allocation decision. Again, the old line about how do you cook a frog, how do you boil a frog, just turn the water up slowly, the temperature up slowly, so the frog doesn't jump out. That's what's going on here. It just blows my mind. It's great. You go away from the screen for a day or two, so you can just breathe and be with nature, or watch the ocean, or whatever. Get your head out of the screen, because I'm an addict. Most of the people in this room are addicts. And you come back and you get a clean look at it, and it's like, oh God, you see things maybe you didn't appreciate before. Maybe you'll be more bullish, maybe you'll be more bearish, and you walk away from it, and it's like, oh my God, it's like these folks just don't get it. So, I was going through Twitter this morning. It's like, oh, this is the worst first half ever for equities, and whatever, since 1932. Or, oh, this was the worst 6 months ever in the history of recorded bond markets. All this stuff, people citing price and they're citing sentiment. I don't know if the CNN fear and greed indicator can go negative. All right, I'm joking, but they're talking about sentiment and polls and price. And again, I bastardized that line from Oscar Wilde. He wasn't talking about the stock market, and we can go into the full meaning of the text. I know I've taken a liberty with it, but I love using it, even misusing it. They know that he knows the price of everything and the value of nothing. Just because prices have gone down doesn't mean they're cheap. Yeah, they're less expensive than they were before. But everyone's talking about price action and flows. And the price action, this is something we talked about a couple of weeks ago. I think, Shrub, you were the one who made the point, and I want you to weigh in on this. Talking about how we've never seen all this before, seeing anything quite like this before. It's the speed of these moves. It's the speed of these moves which is so worrisome. It's clearly catching people off sides. Vol was underpriced. People get caught with their pants down. And so I just think it's going to get worse. And why am I saying that? I'm not trying to play on people's fears. We're not coming in the second half of the year. And once people see that prices, they went down, but you know what? They're not coming back. At least when you got hope, that's something. But in a momentum market, the longer something doesn't go up in a momentum driven market, the more likely people are to give up. And so there will be redemption. There will be redemption. It's just not the kind that Chase Coleman wants. I think you're going to see a massive, massive, epic, record breaking for the history book flow of redemptions out of hedge funds in the second half of this year. And these hedge funds are going to be revealed for what they truly are: compensation schemes, beta chasing merchants, pure beta, no alpha. Kathy Wood, I'm sure someone can give me the more updated figures. Kathy Wood, she got what, another 800 million bucks in or something like that over a period of a week or two. Again, things you don't see at the bottom. I've said before, tongue in cheek, only half believing it. The trick is the market never lets you get in on the way up. Kind of relentlessly went up for years with no real big correction. Leave COVID out of it. That was a one-off. And what if the trick now is the market's basically not going to let you get out? You see, what's really what I like about getting squeezed in the short side is you see what the market's got. It's like trying to roll a boulder or a big snowball up a hill. You only can get it up so far, and then they tire and it goes back down again. So I love seeing these squeezes because the price discovery you get in the squeeze shows you that the other side's got nothing. Nothing. This market won't bottom until you got capitulation, until you see the public selling. So, on that happy note, so Mr. Thornton, it's good to see you again. We were together 8 days ago. We co-hosted the room with Julian, and hopefully Julian will weigh in here for a bit of his updated views. But it's been a month or two, I think, Tommy, since you were the man on the spot. Always like to hear your thoughts, and so you've been a very generous contributor to this room, sharing your wisdom with the folks. And so I thought it'd be a good occasion to just give you the mic and sort of reset where we are, third quarter. Lots happened. Kudos to you for once again annoyingly calling the counter trend rally. My hat's off to you. You're really good at that. I don't know if you sold everything in time. I'll let you tell the folks what you did or what you're thinking now. But that was then, now is now. So let me tee it up with a couple of questions and then go with it where you want. So we got the rally we're looking for. And again, I don't try to. You're much better at the short-term wiggles and jiggles than I am. I don't try to get in that game. Yeah, I know there's a month-end nonsense and the rebalance. I get all that, and the market indicators go negative. I know I'm joking, whatever. And so you're really good at that. You like the dumpster dive. Me, I'm too lazy. I just try to stay with trend. And so I'm just curious. I guess a good place to start off. Two questions. One, after your successful call of getting a scalping low right, where are you in that call? You still got chips on the table. Have you taken some off? Are you willing to go short? And then secondly, just standing back from the day-to-day, week-to-week stuff, which is those are the shiny objects people like to focus on. What are sort of bigger picture observations that are noteworthy to you that you think the crowd is not focusing on? So without further ado, Tommy, the floor is yours. Always good to hear from you. Welcome, my friend. Take it away.
Hey, George. Thanks for having me, and hello to everyone. Happy Saturday. Happy 4th of July weekend for everyone in the U.S. and for everybody in Great Britain. Enjoy the British Grand Prix. Sorry we broke off a couple hundred years ago. So the market. Yeah. Okay, let me just update where I see things. Now, it's not, first of all, it hasn't gotten any easier. It's actually gotten a little harder because when I've found a couple of opportunities to buy things where I see with the plethora of indicators that I use, the bounces are becoming a little bit more shallow. And I'm looking at the S&P futures for this year, and I'm just counting the bounces. I see 7.25, 7.5, 12%, 4.5, 10%, and the last was 8.5% off the lows and viable lows. And the thing is, I thought that this last one would be somewhere in the 10 to 15% level. And I use various time frames on some charts, and I like to look at in choppy markets like this. I like to look at the 60-minute time frame charts, and those have worked really well because I think that that's almost the attention span that this market has right now, the attention span to good and bad news, and so that's those have worked well for me. I again I'll be honest. I had the middle of the month from the 10th to the 17th. I had a really miserable time, and I took some losses. I I can't. I took some losses, and at that point, I actually did some capitulation on a few long ideas that I was holding on to. At the I did buy, and I from the 27th and 28th, right before we really started to fall apart, I took 18 positions off, and I'll tend to run about 30 to 35 positions, long and short. But I'm now with, and I've kept a high level of cash. I'm now at 50% cash, and one of the things is, I don't manage money for a hedge fund anymore. I'm not a trader at a hedge fund. I manage money for myself, and with all the people that I work with, a lot of them can't short stocks, and they're not going to be as aggressive as I would be. So I recommended a fairly high level of cash, and I don't see capitulation, George, as you've talked about. And one of the better charts and the better uh, research reports that I get every week or two is the Bank of America flow show. And they've been showing credit outflows since September 21. It really peaked at that level. The equity outflows really hasn't materialized. If you look at the Kathy Wood ARC inflows, outflows, that actually has shown some outflows. If you look at it on a weekly basis over the last year, it actually had a really big weekly outflow this week. Um, you're going to see the outflows really capitulate probably later this year. I'm thinking into the third and fourth quarter. The big thing that I'm looking at right now, and outside of the CPI and the inflation data, which I think might, there's a lot of people that are in this oddly hopeful way, and Julian could probably confirm on this, that they are thinking that if we get a little better inflation data, that's bullish because the Fed's going to not raise rates, but that's untrue. I think the Fed's going to continue. They've been completely clear about that. And if the market goes up, that's obvious. They're not going to stop raising rates if the market goes up. They want financial conditions tighter. And with the stock market going lower, that tightens up financial conditions. So it's almost this weird thing that I'm hearing, oh, well, the CPI might be a little lighter. I don't think that's going to be enough for the Fed to turn. I don't think, I'm looking at Grant Williams sent out something to me, tweeted the Atlanta Fed has this negative GDP forecast. Okay, fine. That's coming down the road. But in the meantime, I don't see the Fed lifting off. They're just started QT as well. So they've got a long path to go. And there's really not much that I could see the Fed making a turn. And that's actually what the bulls have held their head on. They're saying this is what's going to turn the market. That if the Fed slows down, if they do 50 or 75 basis points, that's not necessarily overly bullish enough for me. The other thing, again, going back to the inflation data, it's all about the earnings that are coming out right now. And, it's been talked about in this room that this has been the first bear market where we haven't seen earnings warnings and earnings guide downs as we have in the past, because usually you get those at peak levels where you see those are big surprises. Now let's talk about a few of them. Nike came out and they missed their lowered China numbers. So people were expecting weak China numbers for the obvious reasons, but they also had weak North American numbers and guidance. And that, I think, was something really scary in the sense that, we're now seeing the consumer, which Nike is a really good barometer for the US consumer, they're starting to slow. And the stock went down 10%. And I think let's remember 10%. Now you had Restoration Hardware. And I will say this, there's a lot of CEOs out there that will just spin the same old happy talk despite the house on fire. But look at the yard. We have a beautiful yard outside. It's great, but your roof's on fire. No, but the yard. We have a pool. Anyway. The point is, Gary Friedman of Restoration Hardware gets my award for the CEO of the year. Okay, I think he is a very, very smooth, good operator. He puts his money where his mouth is. He bought stock in, I think it was 2016 or 17 at, they may have split a couple times. I don't know, $25. I remember seeing him put $1 million open market purchase into the market. The stock was garbage at the time. Nobody was really following it. Boom, it worked. And he sold stock at the highs, and he's continued to sell stock, but he's been honest about the macro environment with inflation, with what's happening with margins, and he's said it several times. He's been on 2 conference calls. They just guided down again, and he knows the stock's going to get hit. But here's the thing, why I think he's a good guy is because when this thing bottoms, he's going to be the one putting his money where his mouth is, and he'll buy stock, and he'll tell you honestly. Now, Texas Instruments used to have management that would do that with semiconductors. It's been a big turnover in their management, and now they're just a buyback machine like most of them. But you had Micron. They just came out and guided down. I think their revenues were expected around $9 billion, and now they're like $6 to $7 billion. That's a substantial guide down. It's really noticeable. But here's the thing. I saw analysts like Mizuho, their analyst said, well, maybe this is a good thing. It's going to reset. It's, $50 is the book value. It's going to get people more involved in the stock at this level. Well, maybe. But if we're just going into this cycle, a semi-cycle that is going down, and semi-cycles go down when they cut CapEx. So they are cutting CapEx. So Applied Materials, Lam Research, ASML, you look at those stocks in the last day, they got mushed. Taiwan Semi, crushed. So I think that we're starting to realize what is happening out here. And semis are a barometer of the economy as well. And they have an oversupply. Whoa, what happened to the semi supply chain problem? Seems like that's not as big an issue, but they called it out on semis going into PCs and cell phones. Okay, well, those are substantial. And the thing that I look at semis and cell phones and PCs, that also correlates with job growth or new hiring. A lot of times people will hire people, and here's your new laptop, here's your new phone. So if that's starting to slow, we're going to probably see some macro slowness in hiring. And that's not something that's a quarter. That's not a quarter or two. That's a year-long type of problem. So right now in the market, what I'm watching for are pre-announcements. We're going to have them. Okay, we've had, I should mention, Walmart, Target, Kohl's the other day. I mean, they can't even sell themselves at a discounted price. They've guided down. They've said that there's big inventories. Inventories, when you have large inventories, you got to mark things down. That's going to hit margins. So that's not good, and that takes time to get through. And now you're coming into the important back to school season in the next couple months. They're probably slashing orders with their suppliers. That's going to hit cotton prices. It all connects. So we're watching right now. We're in the beginning of July. We're all watching for what's going to happen with earnings. And when I was on last time, George, I said just everybody watch out for Jeffrey's earnings this week. Jeffrey's earnings came out at, I think, 41 cents. Their estimate was 53 cents. The last 3 or 4 quarters, they've done $1.20 to $1.30 per each quarter. That cut in half by, I mean, actually it was cut, 3/4, 62% it was down year over year. That's substantial. There's no deals happening right now on the street. There's no issuance. There are no M&A deals closing because they're getting pushed out because valuations are being questioned again. That's going to start to show up in JP Morgan, Goldman, Morgan Stanley, I think Blackstone substantially. These companies they always start the quarter and how's the, this earnings season, how's it going? It's going to be an utter disaster. The other thing is you don't have analysts lowering estimates fast enough. And that's going to be the problem if you show Goldman miss by multiples. I think there's real risk to the downside. Tech, you haven't really seen a big tech company in a while guide down. I mean, you did have Google and you did have Amazon, give some, not so great guidance, but they haven't guided down again. You haven't seen Apple guide down, and they make phones that buy Micron chips or other chips. That could be slowing. Microsoft guided down because of, quote, currency. Maybe there's something more there. But these are the big cap names that we're going to have to watch. And I think that this is the point of this right now where it's going to be a battle over earnings. And I'll leave it at this. There's going to get a point to where things go down enough to where it's not so bad. Things do get priced in enough. The bar is a little lower. I just don't think that's there yet. And I don't think people are expecting it. And that's a big problem. And last thing, Tesla, they're supposed to come out with their deliveries. I don't know if they've come out yet today. I'm looking at my Bloomberg. I haven't seen it. But their deliveries have been slashed with the analysts by 30 to 40%. And it's pretty obvious, China, and there's other things. But just like Nike, we're probably going to see a start to a lack of demand. So I'll leave it there. And sorry to bum everyone out. I'd like to be a little bit happier, but
no, Tommy, that's great. That's a terrific tour de force. So and it gives us a lot of ammo here to run with. So one of the points you kept coming on, which Michael Kantrowitz has made repeatedly, and others in this room, I totally agree with. The so far all we've really seen is the multiple compression. That's been the multiple compression of this move down. Earnings estimates are only just starting to roll over, and I agree. I think from here it's going to be earnings, and Michael Belkin was in this room a little over a week ago. People may recoil in horror at the full extent of the projected number of $110 a share or something like that. 23 street estimates or
everything's always George.
Yeah. Sorry. Michael Belkin was looking for an absolute wipeout in earnings. He was thinking that S&P earnings could fall as much as 50% down to $110 a share for next year. That may be over the top, but directionally it's great. The street still looking for up earnings.
George, we're still
George,
losing a
it's
little
real
bit.
bad, George. It's real
Sorry,
bad.
guys. Hey, let me.
Yeah,
sorry, I don't know
you're
let me move over to the window.
Better
now.
Is that any better?
Better now.
All right, fine. So
Yes.
I wasn't moving.
Yes.
I don't know why it went bad. Anyway, so I was just talking about how Michael Belkin, was really in the vanguard, looking for as much as a 50% decline in earnings for the S&P next year. That may be over the top, but I think in terms of magnitude and direction, it's interesting. Contrasted with street consensus, we've continued to see earnings estimates drifting upwards. I mean, I think they just started to roll recently, but the streets, I don't know, 230, 240, something like that. And if we're in Vegas taking the over under, I'm just going to do simple napkin math. And I said, hey, you know what? Under 200, easy, not even a question. And with the S&P, wherever it is, at 3,700, 3,800, it's like, what are we talking about? There's nothing to discuss here. So, you want to play your napkin math, do 15 times 200 is 3,000, plug in whatever numbers you want. Again, equities continue to represent return-free risk. Valuations are not cheap, and earnings estimates are about to get totally destroyed, in my opinion. So, Tommy, I think you're completely right. Fingering from here, it's the earnings disappointment that's going to set in. The other thing too, I would observe just listening to you talk, when the first guy does it, sticks his neck out, and we're going to have a bad quarter or whatever. They can get a mulligan. They can blame it on whatever they want, COVID, China, whatever. But once one of them does it, it gives air cover for the other ones to do it. So these guys run in packs, and so I would expect, not just because underlying business is getting worse, but also because others have sort of set the bar or lowered the bar. It's now okay for others to come out with earnings disappointment. So I completely agree with you. I think earnings are the name of the game, and so that's one point. The other point is, I saw we had in Aces. I need you to update your view on energy a little bit. And guys, you know what? Listen, we're all here just trying to help each other. Nobody knows. We're just trying to figure this out together. And I think we got something really special here in terms of all the disparate inputs we get from smart cookies and all parts of the markets and the economy. So, ACES comes out with this idea that, well, maybe energy prices are going to go down. And I kind of joined him in that call. And then Belkin, 2 weeks ago, pulls the fire alarm, get the hell out. And, we get it right, we get it wrong. That's not the point. The point is, people hair gets set on fire. And Aces, I don't know if you had to have, you had to call the cops and get special protection or whatever, but some of the sort of vulgar, profane, uncivil, nasty discourse that goes on Twitter. And I know, I realize I run my mouth and I'm critical of other people, but I think it behooves everyone just to try to understand that we're in this together. We're trying to figure each other out. There's room for differing differences of opinion. That's not the point. The point is people get butt hurt because you say something about a stock they don't like, and then they respond with an aha hominum. And people call me out for blocking people. I learned from the master, Mark Cahotes, and I hope, Mark, you're going to weigh in a minute. I just don't want to engage with these people. I'm giving people the benefit of my doubt. These are people I think are friends. They turn on me again, it's not the right side. It's not the bull side or the bear side of the market that counts. It's the right side of the market. We're just trying to make money. So win, lose, or draw, we're going to get some right. We're going to get some wrong. It just people would remain of good spirit and not resort to this insane nastiness which tends to pervade Twitter. So Aces, let me turn to you, and then I want to go to Bob Klein, and I want to go to Stefan. Aces, so they're kind of playing. You laid it out a few weeks ago. Stocks went up against you a little bit, but you made the case. You made the call on energy. So you get a richly deserved victory lap here. You're too modest to take, so don't take it. But just let me talk your book for you. I guess, tongue in cheek, have the death threats slowed down because you've been proven right now? Like, has the oil crowd kind of gone quiet on you? And number one, it's tongue in cheek, nasty comment.
No.
Or does the volume of the vitriol increase as the oil stocks go down? What's been happening there?
I mean, you can't even joke around with these guys. I stopped blocking them because you keep sending me DMs asking me to unblock people, so I just mute them now. But yeah, they've even attacked Dr. Enough, who is the patron saint of oil and gas and has never, picked a side in his life. He just calls it the way it is. I mean, listen, the problem that you have here, George, is that, the bobbleheads on Wall Street and their machines, as you called it in Forbes the other day, created the everything bubble. And that everything bubble hit pot stocks, meme stocks, SPACs, EVs, real estate, used cars, lumber, everything. And they finally made it to the commodities, okay? And there has been a big air pocket in commodities, as you know, and the people who know me know that that's the industry I'm in, right? And the thing that, was the most hilarious was when the bobbleheads were, talking about copper and EV cars and the rest of it. In the meantime, only about 5 or 6% of worldwide copper consumption goes into electric vehicle batteries. So, and now copper's telling us in a definitive fashion that we are headed straight into a recession, right? And, you know, if you read the tea leaves on oil and gas, nobody's a bigger oil and gas bull than you and I, George. Long term, the broken energy policy is going to come back and take all of these people's heads off, just like so many other times when the politicians were lying, cheating, and stealing, and the truth came back to haunt them. This is not going to be the first time.
Ace is 100%. So just hold that thought for 1 second.
Okay.
People, I have my own way of moderating. People tend to like it. I'm doing this for a reason. I want to go down the energy rabbit hole right now. And Bob, if you wouldn't mind just holding your thought for a second, Bob Klein, I want to go to Javier, because Javier is, for those of you who don't know him, good friend of this room, really switched on guy. He's in the Federal Witness Protection Program. He's in the industry, but he's really knowledgeable about energy. And when Javier speaks, I listen. He was also, I don't think he took as much heat as you did, Aces, because he's a nicer guy than you are, and he's not as public as you are. But he was, again, I think back over the last year, few people were as bullish as he was. But about 6 weeks ago or thereabouts, Javier was like, well, I don't know about this. And he was right. And so when I was looking at the charts and again thinking about, you know, who I pay attention to and what are the smart guys saying, Javier got my attention. So I'd like to go to Javier if he could just weigh in on what he sees going in the energy markets, and then Stefan, who has been in this room a couple times, good friend of mine from Germany. He had some really insightful comments a few weeks ago about energy. He's been on the bearish side on energy. He's gotten that call right. So these guys have the cred to have an opinion right here. And so I'd like to have Javier first weigh in on energy, and then after Javier, go to Stefan. Javier, good to see you. What are you thinking, my friend? Javier, are you there? Maybe not. Aces, can you hear me? Hello?
Can hear you perfectly well, George.
Yeah, I don't know where Javier is. Let's go to Stefan. Stefan, are you there? Can you weigh in on energy, Stefan? Are you there?
Yeah, hi, George. Good to hear you.
Yeah, good to hear you, Stefan. So, Stefan, you a little bit early, but you got the energy call really right. I mean, getting direction right's hard enough. Getting the timing precise right's impossible. But it's come right in a spectacular fashion for you in the last few weeks. I'm just kind of curious in the overall scheme of things, as you see the energy trade going your way, how has your point of view changed all you? More bearish, less bearish, and he's got a lot more to go. Just talk to me about energy a little bit. And again, Stefan, you know, went right, made the correct call on energy a little bit early, but boy, has it come right. And so, Stefan, can you just share with the room, what are your sort of updated views on energy right now? Thank you, Stefan.
No, thanks, George. As the last time I said, we are here on Twitter for entertainment, and we have seen a lot of spaces about oil and gas. And so as Druckenmiller said, you have to look at hot and cold, and I think that oil and energy is still hot. So a lot of retail went into these names. You have seen Dan Loeb with EQT. We see that Oxy is the best performing stock of the year, and I think there has to be something to let go. Yeah, when demand destruction is hitting the tape, when consumers getting weak, which we see over the last 4 weeks. So, and then will be the question that people not look at the current quarter. You have seen it at Glencore. Glencore released figures 2 weeks ago. The stock is down 15% since then. And sometimes I watch CNBC, and when the ladies talk, Stephanie, for example, she's only talking about the current quarter. And I think there will be a moment when people will look forward, as you should always do, for the next 12 months. And then they will realize that these oil stocks and energy stocks probably will have different earnings in the next 6 to 12 months. And that is still my call. And thanks for letting me talk. And I have two things. For me, which I said before, George, today I'm a bit on holidays. There was one thing yesterday with cold. I'm still on the negative side for Twitter. I think the risk reward is bad. If you look at Germany, there's a small company called AdPepper. They released a profit warning this week with weakening advertising revenues, advertising budgets get taken out. And that reminds me about the first half of 2009, when we have seen ProSieben going to 1. At that time, Sky Deutschland was trading also at 1. And these are the stocks which give you early sign of a recovery, but also give you a sign that companies are cutting budgets. So I think that Twitter is still trading, I would say 30% too high if you look at what's happening in the advertising industry. And my second point is, and it's maybe to give an open discussion, is about we have seen in November 2020 the BioNTech Pfizer catalyst. I read the book from Catherine Belton about Putin in the last weeks, and it's a great book. And one thing for me, the takeaway from the book was that there are Russian elections in 2024. You see that Medvedev is extremely aggressive on Twitter, I guess for some reasons. So these guys cashing in a lot of money. My personal view is that there will be maybe a solution at the point when these guys made enough money. So a little bit like, remember Iraq, the forces behind in the oil industry. So I think personally that Putin and the other crowd will step down next year. There will be some early elections maybe in Russia. And that could be maybe in this kind of bearish market environment, maybe a positive catalyst in the second half. So it would be great to hear some views about Twitter, fair value, about maybe a positive catalyst in the second half. And beside that, if I look, I read a lot of fact sheets, monthly letters from funds. And when I read about in these letters, I see still like 20-30% downside. What you said, George, with redemptions, and I think these 20 to 30% is still in the market since 2017. These are the gains which are not taken from the table, and these, I think, maybe the gains which will be called in the next weeks, next quarter with redemptions. Thank you. And
yeah, Stefan, thank you. There's a lot to talk about there. But before we go, I want to go to Javier on energy. But before Javier speaks, and then Bob Klein, one thing, could you, Stefan, as you're probably aware, it's mostly a North American crowd that's on this call, and you're sitting, where are you, in the Black Forest, where you are somewhere in Germany. Could you share with us a little bit what's going on with changing European attitudes, particularly in Germany, with respect to ESG and coal? And you see the Greens, now saying, oh, we got to start the coal plants up, blah, 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 because people don't want to freeze their butts off come this winter. Can you speak to what's happening with respect to energy and ESG policy, specifically within the European sphere? I mean, we can all BS each other about oil demand, et cetera, but I just find it really interesting that things seem to be changing a little bit. I remember last year having this discussion with people about, well, the Germans are never going to change their opinion because ESG is like a religion for them, blah blah blah. But now people see how much the energy prices go up and the possibility of a cold winter, et cetera, and maybe the tune is starting to change. So could you just talk a little bit about what you see, how the politics are changing, and in particular, the average man in the street, when they see their bills go up so much, maybe share with people what's happening to electricity and energy bills, and how is the average German thinking about that? That'd be very, very helpful. Thank you, Stefan.
It's a rough call, I can tell you that Vinci, the French company, is quite active in coal and atomic energy construction, and I think Vinci will get good orders. We remember when we had the roundtable about Lanxess. Immediately I said Lanxess at 35 is interesting because of 4 times EBITDA. Then we got the feedback from the others about, but the point when gas is taken off the grid, Lanxess and all the chemical companies, they will suffer. Then Lanxess announced another M&A deal and the stock short squeeze to 45. 0.72 is short, for example. From what I read in the daily newspapers, inflation is at above 8%. I personally think that we kind of peaked already in May. I don't subscribe the point that the German chemical industry is lost at the moment of when something gets taken off the grid. I think they're working on it. When you remember when you were studying, they always called me the German engineer when we organized parties. So remember that the German engineers and architects. They are quite well educated. I think they're working on it in the north. They're building the LNG terminals. When you read the book about Mark Ridge with the oil connection from Iran through Israel via Spain to Europe, I think there are alternatives you can use. But at the end, all this war in Ukraine is, I think, my personal view is about money. When you read the book from Bollow about the Butler of London, I think you also come to the point there's a lot of corruption involved, a lot of cash flows for people who are really greedy and want that money. So, but to your question, I think people holding back, that the German savings rate is extremely high. We have record saving rates. I think there's some caution in the books. We have, I think personally, still a very strong real estate market, one of the best in the past years. I think it's also a bit overrated to call down the real estate market, because I think there will be also some kind of balancing out in the interest rate. We have still a very, very defensive European Central Bank. We will see how that works out, the strategy they have. So from my point to your question, I think I don't sign the point that we are fully dependent on Russia. And I think it's a little bit overpriced in the market on the negative side. So be careful with the stocks which trading at 3 times, 4 times EBITDA.
Yeah. No.
And many stocks in Europe, many cyclical stocks are back again 4 times EBITDA where they were in 2020. And I think there's a good risk reward in the second half to start to look at them maybe in October, November, like 2020.
Thanks, Stefan. Really appreciate your input. If you could stay on stage, I'm sure there'll be some follow-up questions. In the meantime, Javier, if you're back, if you could unmute yourself. I guess we're having technical difficulties before. Javier, would love to hear your thoughts, particularly on energy. Javier, are you there, please?
Happy 4th of July weekend, buddy.
Good to hear from good to hear from you, man. So what's going on? It's I always am sitting up in my seat, very attentive when Javier speaks. I listen because you got a front row seat. And just talked. We're a bunch of financial pretenders here, but you're the real deal. You're in the markets.
No, I'm not the real deal.
No, all right. Well,
I'm going to express to you.
All right. I'll stop with the. Yeah. So Javier, what are you thinking on energy now, my friend?
Well, I'm not the real.
Aces, can you hear him?
Now, Javier, you got it in a bad way.
Yeah, Javier, you're in the matrix again. Maybe can you go out and come back, please? While Javier is trying to fix his connection, let's go to Bob. Javier. Yeah, Javier, if you could please leave and come back. You're in the matrix. Javier.
I'm going to give the same of commodities, right? Backwardation and containment commodities. If oil is $70 in August, and it is.
Hey, Javier.
Oil is $70 in August, and oil is $80.
Javier, Aces, can you hear me, Aces?
The last sentence I heard him perfectly.
Yeah, you know what? Javier, could you please leave the room and come back? You're in the matrix. We really can't hear you. Javier, please leave the room and come back. Bob Klein, my friend, good to see you. What's on your mind, my friend?
Hey, George. Well, there are people more qualified than me to speak on energy, but I wanted to go back to Tommy Thornton's point about the Fed and what they're faced with. They just started QT, and people are already talking about them easing. And one of the flies in the ointment is that, as you guys know, banks create money through credit expansion, and bank loans are up 10% now year over year, total bank loans, and they've been accelerating. Now, I know that they're going to slow ultimately as the economy does slow, and loan growth will slow. But for now, loan growth's been very strong, and that means money growth is not going to slow as quickly as the Fed would hope. So that's going to make it a little difficult for them to pull this off because they would love to ease as soon as possible, but bank loan growth is going to create a problem for them. So I want to make that point, but I have a question, an observation and a question for the old timers in the room here. Jim Chanos has made the point that there are so many companies with harebrained valuations that are not making any money and won't make any money for the foreseeable future. And just running down a quick list here to give you an idea what I mean, stocks we're short or have been short. Firm holdings, $1.40 is for 2025, their estimated consensus estimate is to lose $1.40 a share. That's $400 million. Coinbase estimated to lose 65 cents a share in 2024. That's a loss of 144 million. Carvana, which I know a lot of you guys are involved in, 98-cent loss in 2024, 185 million. Robinhood, 2025 expected to lose money, 67 cents a share, 584 million. Rivian, 377 loss per share, 2025, 3.4 billion in real dollars. So my point is, I was shorting stocks during the dot-com bubble, and I remember that time pretty well, but my memory is fading a little bit. I think this is just bonkers. Even compared to the dot-com bubble, you have substantial, companies with substantial market caps. All these companies have at least 5 billion market cap that I listed, and they go up to almost 30 billion. And so these are substantial market cap companies that, for the foreseeable future won't make a nickel. And this just is mind-boggling to me, just mind-blowing that this is occurring in the capital markets right now, even after prices have come down a lot on these companies. So I just wanted some of you guys to weigh in. In terms of your memory, I remember there were stocks like Pets.com, there was Webvan, and a lot of the crazies, the fringe kind of companies that had goofy valuations, but nothing like this. This is just over the top mania.
Bob, 100%. And I did not pay Bob to say that. The thing is, and when it speaks to, go back to my earlier remarks about anchoring and people anchoring prices over where the peaks were, last year. If you just came down from planet Mars and I didn't show you a chart of the stock and I just said, this is the business, and many of the names you mentioned, I've been short or I'm short. And I didn't tell you what the company, I didn't tell you what the chart looked like. I just said, this is what the company does. These are the sales, these are the earnings, these are the growth rates, the losses, not earnings. This is the valuation. What would you pay for it? And you'd say it's complete insanity. And so I couldn't agree with you more. And yes, some of the names you talk about are just long duration, the proxies for long duration assets. Think 30-year zero coupon bond or the 100-year Austrian zero coupon bond. So they're going to, and they're not as earnings driven because they're more valuation driven. So even in the context though of rates coming off, if they do, we get a recession. I mean, the 10-year sold off the last few days. It doesn't really matter that much because they're falling from such a high precipice. I completely agree with you. You're 110% correct. And so I see Kantrowitz in the room, and he's the man with all the numbers, and he's smarter. He is the smartest guy in the room. And so I'm sure he's got opinions about this. I couldn't agree with you more. And I think those things have a long way to fall. And what people need to remember, it's not just the valuations and the poor earnings prospects for a lot of the companies you're talking about. It's the sociology of ownership. You look at the shareholder structure. You look who owns all that crap. It's, a lot of the more aggressive Tiger Cub funds own that rubbish. Just go through. I went through the exercise of going through Tiger Global, D1, Lone Pine, et cetera, et cetera. And then the Kathy Wood and all her followers. The wrong people own these stocks, and they got huge unrealized losses. So just from a supply demand, and not to mention from a supply demand standpoint, in a lot of cases, one of the tricks that many of these companies played was the tight float game. And I can go through the numbers on Robinhood or Coinbase if people want to, just from memory. I mean, Robinhood came public last summer, and I think only 15% of the company was floated. Came public in the mid 30s, went to like 80. I think it's 8 today or something like that. But the point was that was a hot deal. That high valuation was sustained by dint of the fact that the float was so small. And as the unlocks took place, there was a small unlock in the fall. I think there was a convertible bond. But the real kicker was, I remember calling this. I don't like to make individual stock picks, but last August, and then I reiterated at the end of November. I'm not trying to be a jerk and take a victory lap. Just you can look it up. It's in my Twitter feed. I reiterated the Robinhood short. I think it was around 27 in late November last year because an unlock, and you'd say, "Oh my God, are you sure?" Yeah, no, these numbers are correct. The unlock on Robinhood, I think if there were like 800 million shares outstanding, they did an unlock of like 550 million, like on December 1st of last year. So all the poor retail folks who didn't read the fine print, the thing gets IPO'd 15% of the float, and then a few months later, you got another 70% of the float being dumped on top of you. Forget about fundamentals. Like that alone is a trick that the underwriters play. And is it legal? Yes. Is it unethical? Should the laws be changed? Yes. This is just one of the tricks that the companies and underwriters engaged in together to really jam up valuations. And so I guess what I'd add to you, I'm going to stop on a rant here. It's the relevant point I want to make. I'm agree with everything on the fundamentals. Key point I want to make on top of everything is the ownership structure of these companies. The wrong people own these stocks, and fundamental value is far, far lower. So I think it's just going to be, you're going to get tax loss selling too as we get in the second half of the year. It's going to be a complete nightmare. Let me just stop there.
Hey,
Kantrowitz,
George.
if you're available. Sorry,
Hey,
go ahead.
George.
Yeah.
I just want to mention one thing.
Yep.
I want to talk about market sentiment. I've never seen anything in my life, and I've been through a few cycles, where mutual fund managers, hedge fund managers, let's say people on television, let's say asset classes, they're down substantially. They're crushed. I mean, they're eviscerated their reputations. But the enthusiasm for all this stuff remains super high. I mean, people are still trying to buy the bottom in ARK funds, and they're still trying to buy Bitcoin and cryptos. And is it a good time to buy now? I mean, look, it's going to take a long time if these ever come back, and I still think that there's a lot of downside left until
100%.
we see those
100%,
people,
Tommy.
until we see those asset classes go away. I mean, or they just become out of the everyday mainstream financial media conversation. That's
Tommy,
when we'll see a bottom.
100%, Tommy. 100%. All right, listen.
Tommy, hang on one second. So, Tommy, the everything bubble has everything else is blown up, and now that crowd is in the funds. It's just the same everything bubble has made it now to passive funds, and they're next.
Yep.
Well,
all right,
that's been talked about a lot, and until we see wholesale liquidation of some of the passive funds, I still see funds being created. Oh, sorry, George.
No worries. Hold on.
George, I'm going to lose service.
Yeah, I know. Just hold on. I want Javier to talk. Javier, the floor is yours. Javier.
Thanks, brother. Listen, real quick. Yesterday, I was told that I just don't understand that people who touch the barrel are too close to the oil commodity and are too bearish. That's what I was told by a guy who's invested in the market and speaks every day about the new Bitcoin that oil has become. I'm listening to people who have been pounding their chests to the public irrationally about upside. Am I bullish oil? Absolutely. Do I believe we're short? Absolutely. Do I believe that over time we're going to have to have a significant investment in CapEx and OpEx to be able to increase supply? Absolutely. But the reality is this. Around the globe, we are seeing destruction. If you get away from gasoline and diesel, the markets are contango. We're building stocks in light-ins. We're building stocks in chemical feedstocks. We're building stocks in ethanol. We are building stocks in things that people use. We have right now a refining capacity constraint. 97% U.S. Gulf Coast last week cranked out 6 million barrels of diesel and gasoline. Here's my prediction. I'm going to say that we do not get better than minus 2% 2019's driving demand for the holiday weekend. If that's the case, we are getting ready to see a bit of a squish in oil, and that's okay. $70 oil in September, if we're backwards, and diesel is 60, is still bullish oil. We do not have to go to $150 to be bullish oil. The problem that I have with these guys, these talking heads, these new geniuses in energy markets who decided to show up after we've been doing it for 25 years, is that it now has to be 150, 175, 200. Could it go there? Absolutely. There's a lot of different ways that you could have an extraordinary event. I will. You're not going to see equity upside. You're not going to see the oil companies push into some new paradigm of nirvana if oil goes to $225. I'm listening to small cap companies tell me that hedging is useless, that they're going to ride the physical commodity. They have no use for hedges. And then the third thing is this. If they're going to throw the bathwater at fund managers, the energy equity, which is what we've seen. We've seen futures and we've seen physical detach from private and public companies. And it's not, free cash flow, free cash flow. That's great. Okay. But if I'm a fund manager and I'm covering margin calls and losses across the board in every platform, and I'm up for the last 6 months or whatever the time frame is in energy, it's gone. If you go pull it, I'm going to say it again. There's a Bloomberg code. It's called .mmlosh. It is the managed money long short index for commodities. It is one of the best indicators of sentiment across the board, and it does not preclude, include, or exclude oil and gas from raw materials. Until that ticks up, you're going to see a drawdown across the board in all commodities. This is a deflationary environment for commodities. We are under the GOC, the Ichimoku cloud, in almost every commodity out there. It doesn't mean that we can't go higher. It means that it has to retrace. We have to build bases. We need to see demand uptick. And I want to see the rest of the oil barrel start getting bought. We're not seeing it today. That's it. I'm going to lose service, George. I love you.
What's that Bloomberg ticker?
.mmlosh index. It's the managed money long short in commodities. Take a peek.
Okay, thanks.
So again, for those of you that aren't familiar with Javier, he is, he's got his hands on the barrels, and he's in that real market. It's not just a financial, macro commodity tourist. So when
not according to yesterday. No, I don't understand.
I know. But when Javier speaks, I listen. Hey, Javier, your connection is really bad. So I don't know if you get to a better place, speak up, but it's really kind of hard to hear you. So anyway, the point is, Javier, come back when you got a better connection. The point is, when Javier speaks, I urge everyone to listen. He had a great call 6-8 weeks ago, as did Aces, and my hat's off to him. All right, so let's move on here. I want to do Shrub, and then we're going to do Cantro. Shrub, talk dirty flows to me, Shrub. How are you, my friend? Shrub, you there? Please unmute yourself. Shrub? Aces, can you hear him?
Nope. His speaker. Now, are you there now, Shrub? No, Shrub, we can't hear you, bro.
All right. Hey, Cantro, are you there, my friend? Cantro?
Hey. How you doing?
Michael. How are you, Michael? Good to see you. What's going on?
I'm good. I can come in and out. I'm playing golf, so I got a few.
Between holes, you can tell us what's going on. What's going on, my friend?
Well, it's all playing out. I think in a fairly textbook fashion in terms of the economy falling apart. Now everyone's starting to realize how bad the earnings are going to be. I was listening. I just jumped on when we talking about negative earning companies, and for so many reasons, I think people are going to get run over. They're going to try to dive back into those because of what happened in 2019, and this is just so different than 2019. When the Fed pauses, when they're done here, it's probably going to be when claims are rising higher, not because inflation's coming down, and you'll have a real short relief rally, and then like you saw in the fourth quarter 2000, reality is going to hit, rising unemployment claims, falling earnings numbers. Just from where I sit, from the 100,000-foot macro view, this is as bad as a cycle as I've seen in 40 years, and we're nowhere near the bottom. We'll have relief rallies. We saw a horrendous ISM report last week, and the market went up because bad news is good. That's only going to get you so far, and that only really works when we're kicking the can on the Fed, like before they raise rates. Once they're this deep into it, and we're this deep into the slowdown, earnings are going to make up for that. So there's no bad news earnings that's good for stocks, and that's going to be, I think, real clear over the next 6-8 weeks when earnings come. So I don't really have anything specific to say, but from my seat, everything's playing out in textbook fashion. Still don't think we're anywhere near the bottom of either the economy or the market. But we're now in this period where people are going to look at bad macro data and try to use that to jump in, is hoping the Fed's going to pull us out. But again, I think the best parallel is probably 2000, just in that you had a few months of a rally, and I think this will be shorter than that. And then everyone gets sucked back in, and then in October, claims shot up, and that's it. It was lights out.
Right.
So that's to me what I'm focusing on. Claims.
Kantrowitz, you've been spot on. Again, not to embarrass you, but I've said it once and say it again. In my view, you're the best strategist in the street. So when you speak, I listen. Question, my friend. On the controversial energy call, I think I know your views, but could you just update your energy views of what's going on right now?
Yep. So, we're still overweight. We've hung on to it. We were market weight last year in energy, overweight this year, and getting close to flipping that. But again, I think it's more about claims. We look back at 2000, 1990, 08. It was not when claims started to rise, but, it's lights out when that happens. So, I don't think we're that at risk of a sharp rise in claims in the next 3 months, but I think in 4 to 5 months, absolutely. So I'm willing to hang on for a little longer. We're thinking about parts of the market that aren't going to get blown up. I think I'd rather own energy than financials here, or industrials, or even materials.
Yeah. So Kantrowitz, that can into individual picks. If we just talk sectors and styles, I know you're negative on the consumer. If I said to you, what's going to lead on the downside from either a sectoral or factor standpoint, what would you say right now to help everybody
Beta.
in the room?
Anything beta? High beta. Negative earnings, high beta, low interest coverage, small cap value, machinery, banks, autos, everything that's been getting its ass kicked for the last year on a rally. All the stuff that peaked in March of last year is now getting hammered. And that's all that stuff I mentioned. If we're going to get a bounce and a relief rally, it's going to be growth stocks that bounce. So, to me, the pain ahead is from claims and credit spreads and earnings, and financials are at the top of my list of what should be at the bottom of the list.
And consumer stocks, I presume you're negative on as well still?
Yeah, for relative, autos, no thank you. Housing, way too early to jump into anything close to that. As long as the NHP is going down, housing stocks are underperforming. That hasn't, relationship's been locked tight. With respect to once you see the Fed pause and oil and bond yields start melting, then it's time to relatively get into some retail stocks and housing stocks. But I think that's 6 months away.
Yeah, and there was one last question. Could you just sort of, because you're the man with the numbers, and like us, we just bloviate and talk about our opinions. You're actually the facts and numbers. Can you just give your thoughts on earnings for the market 22, 23, where's consensus, and what do you think about earnings, Kantrowitz?
So consensus now is 229 for this year and 250 for next year, which is absurd. Honest question. I say this straight to clients. I have no idea how bad they're going to be, and I'm not going to pretend I'm going to be able to model them, because not only are we in a downturn, and good luck modeling earnings in a downturn like this. Everyone's models are based off of, if you think about it, 95% of the time we're in a slow and steady, good economy. So your models only work in those types of backdrops. When you get a fat tail event like a recession, models are terrible. And so not only that, your point, George, you mentioned earlier about recency bias or reference bias. 206 last year was in a year where I'd say the global economy, U.S. economy, had the highest propensity to spend. You gave people money, $7 trillion. You created a housing bubble. You want to get people to spend, that'll do it. So the we, real simply, I think, the worst two markets in the last 20, 30 years have been the multiple-driven tech bubble blow up and the earnings bubble that ended in 07, 08. That was an earnings bubble, after a 20-year debt bubble, ultimately created an earnings bubble. So, 2007 and 8 wasn't about multiples too high, it was about earnings too high. I think we've got both of those right now. In the last 2 years, we've had an earnings bubble and a multiple bubble. So people that are looking at like, oh, we're only going to fall 30% from their high. And again, I think the reference point from that is idiotic. When you shoot up as fast as we did, you can't use it as a reliable reference point. So, just like we saw in 2000, the reference point was irrelevant. And so I think we're beginning to see the multiple compression, and now we got to unwind the earnings bubble. So, I say this to every institutional investor. I have no idea. I don't really care, because at the end of the day, what I know is that markets will bottom when leading economic indicators will bottom, and that's when earnings revisions will bottom. And no one's going to have a clue what the earnings number are, including me, including anyone here on this call. And you don't need to know what the earnings number is. It becomes more macro and more sentiment and leading indicator driven, the more this economy slows. When you have extreme recoveries or extreme collapses, which we're in, modeling, good luck. So I just think it's a lot lower from where we are today, and I'm not going to put an earnings number on it because I have no clue. And a model, anyone's statement is only as good as conviction behind that. And all the time I get asked by clients, what's this number, what's that number, and I say, listen, I can run a regression for you, but I have no confidence in it. So that's my answer.
Kantro, I just love, you spot. I couldn't agree with you more, and I just want to thank you for all the guidance you've helped me and the clarity of my thinking. And I urge everyone to follow Kantro. For my money, he's the best strategist on the street. Public. Before we go to Julian, who's going to weigh in, just a public service announcement. If you know of any bulls that are in the room, you should if you have any friends, this is not a safe space for them. They should. They're asked to leave right now, because we're going to go from the frying pan into the fire. You were talking, Kantro, about earnings, and we had Julian Brigden in here 8 days ago, and Julian's not going to pile on, but what I love about Julian, he does things totally differently from you, Kantro, and he sits, well, actually he's in the U.S. these days, but from a totally different perspective, he kind of comes to the same place, and that's what I really love about having all these sharp cookies in here, different MOs, but we kind of wind up in the same place. And so, Julian, I suspect your view hasn't changed much in 8 days, but maybe mark to market, if there's anything you've seen that's happened that changes your view or bolsters your view, or maybe any of the comments from Kantro or Stefan or Javier or Aces or good mutual friend Tommy Thornton. Julian, you got anything that's top of mind you want to contribute to this mess? Julian? Please unmute yourself, Julian. I don't know. Aces, can you hear me?
I can hear you perfectly. His speaker's still red.
Yeah, all right, fine. Let's go to, while we're waiting for him, Nora, if you're there, welcome to the stage, Nora. It's the first time that we've spoken. Maybe Julian. Julian, can you hear us now, Julian?
Yeah, Julian's there now.
Can you hear me, guys?
Perfectly.
Julian.
Now I can.
Yeah, Nora, if you could just hold on for a second. Julian, can you speak now, please?
Yeah, absolutely. Look, George, I mean, we had this discussion. You said we come about it from a different perspective. I've been modeling the similarities to the dot-com bubble for a while, and I think we're probably about halfway through. There are a couple of things. I mean, I think we've noticed that in the economic data. In fact, we put a piece out last week along with a bunch of sort of buy recommendations on Eurodollars and stuff like 10 days ago. But the data really has started to swan dive in the US. Now, quite what's driving it, I would call it hyper-financialization. So this sort of feedback loop, this self-fulfilling feedback loop between equity price action and CEOs' behavior. So you're starting to see people get laid off. I would totally concur with the uptick in unemployment. We've got unemployment starting to materially, we think it's base now, the unemployment rate should start to materially pick up in August, September. And what's interesting about the unemployment rate, if you track it against its 12-month moving average, unless you get the Fed punting the cycle, so coming in and really aggressively easing, pretty much once you get amongst that 12-month moving average, there's only one way for that thing to go. So I think the odds of us moving into recession are extraordinarily high. I've noted as well in some of the PMIs that we've got in the last 2 weeks, a material change to some of the pricing dynamics. Now, to your prior caller, I think the market's going to try and look at this and call this sort of a Hail Mary pass and say, oh, look, pricing is coming down. But that just highlights if companies can't push the price increases through or having to make concessions because demand is finally starting to show signs of, not imploding, but just the demand isn't quite there, then I think, it may help a little bit on the inflation side. So I can see inflation starting to, in some respects, flatlining a little bit, George. I don't have any major collapse yet. And that I think is very problematic because the Fed has built in a very aggressive downturn in inflation. So I think you still keep getting an aggressive Fed. But against that, if you've got lack of pricing power starting to show up, you have acute margin compression. And we talked about it when I said, if I take it at face value, my models are showing a 50% collapse in S&P margins from 16% at the moment down to 8 or 9. I don't know whether we'll get there, but the direction is absolutely clear. And that's why I do think, to the point, that the next big shoe to drop is these earnings revisions. And then finally, I want to just highlight something else to people. Everyone needs to go and listen to the conference call between Bailey, Powell, and Lagarde at Sintra, the ECB kind of Jackson Hole equivalent from the last week. They finally acknowledged something that we've been talking about for 3 or 4 years, and that is that we may be moving into a structurally higher inflationary world, which has huge long-term ramifications for the corporate sector and asset allocation. And secondly, they talked about as well that this sort of nice, great moderation, which is the economic term that's sort of applied to the period since the mid-'80s, where we've seen a reduction in the volatility of the economic cycle. They seem to be implying that all of those were over. And so I think we need to be prepared for a real move into boom-bust economics, the like of which we haven't seen since the late 60s into the 70s. And it wasn't just the 70s. It started in the mid-60s. And that, I think, to me, was probably the biggest event of the last week.
Yeah, Julian, thanks for calling that out. Could you just slowly repeat that event again? Because I'm certainly going to go listen to it. It sounds like the type of thing we were talking about in these spaces 6 months ago. But could you just, for the benefit of everyone in the room, just repeat again what it is they're supposed to listen to? Thank you.
Yeah, so there's Sintra is kind of Jackson Hole equivalent of the ECB. It's a meeting that they have every year, or started to have every year, in Portugal, in the lovely resort of Sintra. And there was a roundtable discussion basically with the head of the BIS, Jay Powell, Christine Lagarde, and Andrew Bailey, the head of the Bank of England. And it should be available, I would guess, on the ECB website. But if you just put Sintra, Sintra, and those 3 central bank names in, you should find it up on Google or something like that. But it's definitely worth listening to. For those of you who've got access to Bloomberg, John Authors wrote a piece about it as well, I think on Friday. I think the call was on Thursday, I think. This is a real big deal. I mean, this is a structural inflection point with enormous consequences.
Thanks, Julian. Hey, Kantrow, do you want to weigh in on that, Kantrow?
Yeah, no, just totally agree. And if you look back at a chart in the late 60s, basically from 66 to 79, 80. The stock market only went up when the economy was accelerating. Don't look at inflation, don't look what the Fed was doing, just look at, broken record, the ISM. Pretty much only went up when the economy was improving. In other words, P's and earnings moved together. That's what Julian was referring to, boom bust. That's what a boom bust world is, when P's and earnings move together. But within the ISM report just from last week, the new orders was 49. The index overall has been overstated now for the last 3 years, because 40% of the index is supplier deliveries and inventories. And supplier deliveries at 57 because of the bottleneck issues, which is getting better, but that's still artificially holding up the index. And inventories, which is 20% of the index, is now at 56. I suggest anyone who has that data chart to go look at it, or even look at the ISM report on business where they probably have a chart of it. We have inventory levels on the ISM at 56, which you haven't seen in 40 years. And that's what also contributes to boom bust. We haven't had an inventory cycle like this.
Yeah, totally agree.
This is that's why everyone's got these new orders inventories charts that are collapsing, and now you got new orders collapsing and inventories going up. It's the worst case scenario. So again, I'm not a short-term guy, but over the next year and a half, I still think there's a lot more blood in the markets to be squeezed out.
Hey, Julian, are your comments suggestive of a potential debt contagion or crisis of any kind?
Look, I mean, it's entirely possible that you could get a crisis. I mean, I was cheered by the comments of your German commentator. Sorry, I've forgotten the name, about the energy situation. But I look around and you can see the basis for potential crises in a bunch of countries if these central banks are unable to address. I mean, the UK is an obvious one because it runs a huge current account deficit. The US is one, but probably later because it's the reserve currency. But if these central banks are unable to get ahead of this inflation cycle just because of stagflationary acute weakness, there's your potential for a crisis. And I do concur that I think, we talked, in January of 2021, the first piece that we wrote was inflation. We called it the most important variable for 2022. And I think, for 2021, and I think that at the end of last year, the last report we wrote was called Accelerative Oscillations. And we talked about how we are setting ourselves up to see boom bust economics. And I think we all laugh about it on this forum and various other about, how you have money managers who tell you can't time markets. Well, I am telling you now, you need to start learning, because if we're going into boom bust economic cycles where these things literally turn and flip because of that inventory cycle, because you've essentially what I refer to as negative gamma central banking, where basically these guys would get behind the cycle and then have to tighten really aggressively at the highs and then ease really aggressively at the lows. It's like trying, for any of you guys who've obviously known what trading a negative gamma book like, that's exactly it. You pay the highs, you sell the lows. They will add to the underlying volatility, and the swings that we are going to get into markets are going to rip your head off. So if you can't protect some of your money in that environment, this is just, you've got to learn, because this is not a passive investment environment. I think we're going into something which is potentially great from a vol trading perspective, but could be utterly damaging from a wealth management perspective.
Wow, Julian, as not seen on CNBC. Hey, Cantro,
yeah, just real quick, and then I'm gonna go back to playing golf and just listen. One other thing I wanted to mention, because we were talking about inflation, the best leading indicator of CPI is the prices paid index in the ISM, and that's still at 78, which is still a ridiculously high number. So there's no way inflation's coming down fast unless you see that prices paid below 50. And we've been hanging at 80% for the last 2 years. So
yeah,
that just came out.
I totally concur. I mean, that's your PPI pressure. That's what they're paying. As I said, the big thing that has struck me in the last 2 or 3 weeks from some of these surveys are signs that firms are increasingly unable to pass that on. So that's why I think, to Tom's point earlier, everyone's point earlier, there's a shift going on here in the equity market where we need to go from the reducing the P because your discount factor is rising in terms of bond yields to focusing on the E, because if firms have been incredibly successful at passing through price increases, if they're suddenly running into weakening demand and excess inventory and it flips into earnings and they can't pass these price increases on, then that's the next shoe to drop.
100%, guys. I mean, I think we need to have a merger. I think Kantrowitz and Julian, you guys got to sing from the same prayer book. It's absolutely awesome. All right, let's move on. Everyone stay there because this has been a great room so far. I want to go to Nora. Nora, you've been patiently waiting. Welcome, Nora. What's on your mind, Nora? Please unmute yourself.
Hi, everyone. Thanks for having me here. I am enjoying this conversation thoroughly. I'm still laughing at the suggestion that we are leaving the era of, market volatility or boom and bust cycles and market volatility, especially after 14 years of stagnant, well, not just stagnant, real interest rates being at or near zero. And then extreme monetary tightening worldwide. I think this is insane that anyone would even suggest that anyone that would see that we have been doing this for 14 years and then suggest that, we're just not going to have any market volatility in these boom and bust cycles is just, well, I guess they're not economists, obviously. But I kind of wanted to go back to what we were talking about earlier. I agree with a lot of what you guys were saying. I've been really enjoying a lot of you guys' insights. I would have loved I think, Kantrowitz, you said something about you were asking someone to pull up an inventory index if someone could find it, or I would love to see as well. I wanted to go back to when we were talking about where we're seeing stock prices going, and you guys were talking Robinhood and tech prices especially, and I just was going to offer in my opinion that any stocks that I see that are not dependent on commodities prices I see are still inflated. In my particular opinion, I think that they are inflated, in fact, because we still have seen this period of 14 years of zero interest rates and people an inflated stock market, just an inflated stock market in general, and then inflated tech sector, and any stocks or sectors that have not relied specifically on commodities prices.
No, Nora, can I interrupt you for a second, please? Is there a question you'd like to ask one of the panelists, please? Do you have a question?
I guess my question is, if someone can find that that index that Kantrowitz was speaking of, that is something that I would particularly like to see. And then I guess I would like to also go back to Julian and say, if you think that we are entering this period of boom and bust cycles again, what do you think is the greatest indicator? Or actually, I'm not sure if it was Thomas or it was Julian that was specifically talking about unemployment and how that factor in particular seems to be rising. What do you, well, I think particularly that's going to be the factor that influences these boom and bust cycles the most and shows that. But what factor do you think in particular is going to show that we are entering into another, cycle or series of cycles of boom and busts?
Obviously, inventory is one, and there are various sort of metrics you can look at that on that side. I was listening to the ISM call. The chairman of ISM was pretty sanguine, actually, because he was saying that he thinks that, the order books are very, very strong. But we saw as in the GFC that things can get cancelled really damn quickly. And that's kind of my concern there. But you can look at the PMIs. There's some of the best indicators you're going to get in terms of the inventories and what's happening on that side. And I am concerned, there were a lot of commentary in that conference call that he did where he talked about the companies are sitting on very high levels of semi-finished goods that just sort of 80% completed product. They're waiting for those, 2 chips to arrive or whatever. If that situation starts to ameliorate itself, I think there's a real risk that you can go from customer inventories, which are still essentially in famine type levels, to feast to hangover very, very rapidly. So the customer inventory one, I think, is an important one to watch on the ISM. On the employment side, I think jobs opening in JOLTS, I think that number's going to take it in the teeth. It is hugely correlated to the S&P. I mean, just pull up a chart of JOLTS, job openings, and run it against the S&P, and you can see the S&P leads. I mean, this is classic, this financialization we talked about, right, where CEOs aren't paid to produce a thing. I mean, up until recently, not even make a profit. And they're just simply shepherds of an equity price. So as soon as the equity price starts to go down, they cut back on employment and capex. And we've seen it already in announcements. So I think that jobs opening will drop very, very sharply. That's a good leading indicator. The rate of change of claims is a very good leading indicator. And then there's some other sort of metrics that you can look at in terms of things like, some of the economic slack questions that they put out there. Why are your hours down, because of soft working conditions and stuff like that. Those things are pretty good leading indicators too. So I think all of those, I mean, employment is generally a bit of a lagging indicator, but I think we're going to start to see those things pick up unless some dramatic changes over the summer.
Julian, you've given us a lot. That's really brilliant. Thank you so much for that. By the way, just when you thought this room couldn't get any better, we have Dr. Jim Walker, who is now in the house. He's off the racetrack up in near Edinburgh. Dr. Jim, always a pleasure. I know because of time zones, it doesn't always work. We're thrilled that you're here. Dr. Jim, who don't know him, he's one of the best minds on economics and strategy. He's from the Austrian school, so he's been looking at this whole thing through a very different lens. And Dr. Jim, I want to just sort of contextualize, maybe have some comments top of mind, but my mind is drawn back to an observation you made 3 months ago in this room. And like yours truly, you're not a young man either. And you were talking about your early days in the 70s, starting out as an auditor. And you were talking about LIFO versus FIFO accounting and how in an inflationary world, companies don't even really understand what their profits and losses are. And since those comments 3 months ago, the situation's gotten markedly worse. And so I'm just kind of curious, maybe to give us an updated view on sort of update on your global views and how you see things playing out from here vis-a-vis, economies, inflation, profit margins, stocks, et cetera, et cetera. So Dr. Jim, I'm thrilled that you're here. The floor is yours.
Thanks, George. Yeah, the racing has mostly finished, so I thought I'd listen in. I won some money today, actually, but never mind that. It's really interesting, and I've been following Michael Kantrowitz stuff for ages now, and I don't know Julian, but I think that both of them are absolutely spot on about the profit cycle. I mean, they call it the earning cycle. In the Austrian world, we call it the profit cycle. And what people need to realise is that regardless of unemployment, and I would say actually regardless of ISM surveys and the like, the real thing that matters in terms of the boom-bust cycle is profits. Profits drive absolutely everything. And when companies don't know what profits they're making, because they can't calculate them because of what's happening with inflation, then eventually they just stop investing. Now, at this stage in the global economy, what we've got are a lot of people who were out there a year ago, 6 months ago, saying, oh my goodness, we've never had it so good. Let's just pile on the investment. And the ones that I'm thinking about here are TSMC, all the big semiconductor guys. We've got to increase capacity, etc., etc., etc. Our investments are going to make an absolute fortune. They're done. These companies are toast, because the amount of capital expenditure they've built up and put in the pipeline for the next 4 or 5 years is going to absolutely destroy them. They're going to have to cut back on them. They're going to have to cut back in capacity, and everybody's going to be thoroughly disappointed with that whole space. The other area where the profit signals come in and the profit cycle comes in a huge way And again, this is what we talked about a few months ago, George. When these companies go bust on the back of reduced earnings, then it's the financial system, and especially the banking system, that's going to really reap the rewards. And, you know, the rewards are going to be much more in the way of bad debts, much more in the way of loan losses. And nobody's talking about the financial sector at the moment. I think somebody maybe mentioned it earlier, saying that they would rather be long energy and short financials. And I couldn't agree more with them. That financials, I think, are the most dangerous space in the world next to semiconductors at the moment. And having said all that, I'd just like to remind everybody that today's the 25th anniversary of the start of the Asian crisis. And even though lots of us that were out there and maybe foresaw some of that coming, unlike others in the market, we absolutely, totally underestimated the amount of time that it would take to sort the problem and the amount of pain that was involved in getting from pre-problem to post-problem. And I've said this to our clients over the course of the last few months. We're in the first innings, and although you think I'm technically British, and that probably means cricket, what I'm talking about is baseball here. We might be coming to the end of the first innings, but this whole thing, in terms of the profit cycle and in terms of the boom-bust cycle, has got not months to go, but years to go, in the same way that the Asian crisis did.
Can I slip my wrist yet?
There's still money to be made, George, but mostly in tobacco and probably whiskey.
Hey, Julian, are you there? I don't know if Julian, you know Jim, or Jim, you know Julian. You guys should know each other. I mean,
yeah.
I used to work at Credit Agricole for my sins, a French bank, and Jim used to come in upstairs to CLSA when I worked in the New York office, and I would sneak in and get an invitation. And I loved listening to Jim. I always never quite understood how such a broad Scottish accent went over so well in Asia. But no, he's one of my favorite strategists and economists.
Julie, you said you didn't understand how it went over so well in Asia. I thought you were going to say I never understood what he was saying because I couldn't understand his accent. That's another story. And by the way, just so you guys don't know, Walker is a rabid Boston Red Sox fan. So he's a good man. He's a good man.
Yeah, June was a good month, George. Hey, Julian, did we charge you for coming in at the back of the audience?
Well, I used to know the head of sales. I know the head of sales of CLSA very well, so he used to sneak me in.
The reason that I went down so well in Asia, Julian, was that, of course, nobody could understand what I was saying, so therefore I could always claim that I was never wrong.
So Walker, you're basically the Scottish analog to Alan Greenspan. Is that what you're saying?
No, I would hate to be compared to that guy. Let me tell you. Yeah.
Oh, so I don't know. You guys should get to know each other because you're all great minds. I look to both of you guys. It's absolutely fantastic. So let me just reset here. So the consumer incomes are under pressure. So real incomes are falling. We've got an inventory problem. We've now got an emerging pricing problem. And as Kantrowitz was saying, I think he came back in. I'm not sure where he is right now. We're going to have and as you're saying, Jim, we're going to have a capex problem as well. Other than that, everything is fine. Did I get that straight, Jim, or what did I miss?
No, that's spot on, George. Profits drive investment, and when profits go down, investment collapses. It doesn't go down; it collapses.
All right.
Hey, Jim. Hold on, Jim. Did you see the Micron guidance?
Yeah, Tommy and Aces. I have to step away for just a minute, so Aces, if you just run the room for 2 minutes, I appreciate it. I'll be right back. Keep on. Go on.
Hey, just one quick thing, Jim. Did you see the Micron guidance?
Yeah,
they're cutting their capex, and for a semiconductor company to cut their capex, which is very rare, especially for a Micron, that is it's not a 1 or 2 quarter thing. This is a longer term aspect of the semiconductor manufacturing business. And That to me is a really important thing. The other thing is talking about financials. A lot of the big banks aren't buying back stock right now, and I would absolutely not discount a Citibank or Citicorp, whatever they are now, lowering or cutting their dividend. The banks are in hunker down mode right now, and that's a really big tell. So yeah, semiconductors and the banks, very good place to watch regarding the economy.
Yeah,
And great point.
I think what you've just outlined on Micron, I think that's the canary in the coal mine, and there's going to be lots more to come, but probably not for quite some time, because many of them won't realise the problems that their eventual increase in capacity is going to bring them. But yeah, I totally hear you on the banks, and I run scared of them. Of course, being an Austrian, I tend to run scared of them all the time, but at this particular point, I think unless you can be very, very sure that your bank has not made mistakes over the period of zero interest rates, and I can't think of any, in lending to zombie companies, then I think you're in deep trouble.
Jim, have you looked at the issue regarding sort of what I would call private financing of a lot of this risk, so the private equity side? There was a really interesting report by one of the big consulting companies, I forgot which one it was off the top of my head, that was saying there's up to $3 trillion of pre-committed money in the private equity space, and that this money is going to get drawn down. Sure, some of it people might dispute whether they really want to pay it in, but you know, they've pre-committed, and this is going to draw a lot of money from the public markets, because this money, you know, if you're a big endowment, and we know these are a lot of the people who put this money into this thing, because it had the big advantage of not being marked to market.
Yeah.
That this is going to be, this is where a lot, this, if you're looking for a black swan, this is potentially where it is. It's in the private equity space, commitment, you know, forward commitment to a lot of these type of names.
I think that's 100% right, Julian. The private equity space is this crisis's CDO space, subprime space. And I think people have totally underestimated how much in the way of commitments are out there. I think that there's a very good couple of chapters in Chris Leonard's book, the Lords of Easy Money, on that. And of course, it's taking it from Jay Powell, who is one of the kind of big movers in that private equity space. And his stuff is absolutely frightening on how much is out there in private equity, and just how little in the way of covenants are involved now, how much the companies have got away with, and how much the people who have financed it stand to lose. So it's just, I think, completely horrific. This is like the Thai non-bank financial system, 1997. Right. So yeah,
when they were the second largest market for Mercedes-Benz, I remember reading that and going, "Oh my god!"
Yeah. They literally didn't see it coming, and it wasn't even that hard. The Mexicans showed them the way in 1995, but they did nothing about it. And I'm afraid these guys, and it's going back to something that Nora said, you know, we've had 12 years or whatever it is of zero interest rates and easy money and quantitative easing, and nobody's taken any avoiding action or evading action to try and keep themselves solvent. They're all in the game together. It's Chuck Prince, keep dancing while the music's playing. Well, the music's just about to stop.
Yeah, no, Jim, 100% spot on, and a point or lie to that I've mentioned in recent spaces. I'll repeat it again. And that, you know, you point to the length of this upcycle, and the longer the upcycle, the greater the excess, the more debt. You know, adds piles all the bricks up to leading to an even bigger Minsky moment. And looking beyond that, I personally believe, I've said this before, I'll say it again, the likes of Tiger Global and D1 and all these guys and the private equity, all this stuff, it is done. It is done. It is not just, oh, we're going to be down a quarter or two and don't worry, we're going to come back. No. I think we are at a generational high. It could be 10 years, 20 years, all this excess liquidity driven, narrative chasing investing, fake it till you make it. Sort of, I'll just pick on Chase Coleman as sort of as a placeholder for what I'm referring to. That is done, okay. And your CalPERS or whatever, just use them as a representation. I can't remember if they put it was a 400 million or 800 million into Tiger. It's finished. It's done generational wise. So think about it. If you're the chief investment officer for a big endowment or pension plan or whatever, and you just found out you had an 80% off sale, and it's like, well, how did that happen? We were up for so much for so long. You gave back all your profits and then some, and it's gone just like that. Okay. The one thing you're not going to do, once you get the memo, the one thing you're not going to do is put more money into that asset class. So I think the sort of venture capital, fake it till you make it model is done, and it feeds into some stuff Kantrowitz saying, and otherwise we're going to be looking at companies. You want to go for companies that have strong balance sheets, good cash flows, don't need external capital. Short duration over long duration. And what people, again, Chase Coleman and Tiger Global are going to be relegated to the dustbin of history. If someone wants, I don't know if Charles Kinderberger's still alive, there's going to have another chapter written for this excess. They're going to say, how did we ever do this? And you can take crypto and all the rest of it and private equity, all of it, and just throw it down a rat hole. So I don't know if any of you guys, Julian, I probably overstated the case as is my habit, but I don't know, Jim, Julian, Aces, Tommy, anyone have any thoughts on that?
Hey, George, I'd like to add to that. I have a buddy at Wells Fargo who's in charge of approvals for leverage lending, and he says, he's never seen anything like this cycle. He says the recklessness being carried on by the private equity guys, the banks are so regulated they can't do a lot of the loans, so the private equity guys are doing it now. And he says it's just wild what's going on, and so I'd love to hear more comments on this. I think fleshing out what the S is at the private equity shops, it could be very, very profitable. We're short a couple of those names, but I'm trying to learn more. So any insights any of you guys have, I think the vulnerability is enormous.
Julian, Jim, Tommy, Aces, anybody got any
thoughts? We're working on it now, but it's really hard to see, right? I mean, this stuff is all pretty opaque, right? I mean, the problem is I've heard of some funds sticking private equity into their offerings, some hedge funds as well. I mean, this sort of leverage upon leverage upon leverage. I mean, this is CDO squared from what we saw in the GFC. So we're trying to dig into it. It's not that clear, but I think it could be a significant problem when these companies start to draw down on pre-commitments from some of these endowments and other investors. If they've got the cash, fine, but people rarely have that cash. So I just think it's going to add to some of the selling and certainly the lack of money that's available for the public market.
And Julian and Jim, maybe you could take the comment more generally, just what it speaks to animal spirits. And, it's one thing when we talk about the risk-free rate, what the policy rate is, but the implications for credit spreads and just animal spirits. And, you get to a point where people start to become more concerned about the return of the capital as opposed to the return on the capital. And the sort of involuntary contraction that it causes against the backdrop of what's the biggest credit bubble in history. Yeah. I struggle to see how the consequences of this aren't anything other than disastrous.
Yeah, I mean, George, just if you go and look at something like CCC versus B credits, they're highly correlated, as you would suspect, to the underlying economic cycle in terms of growth, because that's obviously that's where you derive your cash flow to pay the debt off. In a strong growth environment, you're fine. In a weak growth environment, you're not. They've actually been remarkably well contained. I mean, most of the weakness we've seen in an index such as HYG is really from the duration component, which is blown out as bond yields have risen. We've really not seen that much quote unquote credit spread weakness. Where these PMIs are coming, I mean, if you take that CCC spread, it's about 400 odd basis points, moved up a little. It should rise at least 50% from here. And that's assuming that, you know, ISM stops here. Right? I mean, credit itself, I still think has got another big leg to go. And it's really from the credit spread component, not the duration component now. And that should weigh massively on stocks.
Hey, George, can I just go back to the macro? I mean, when I hear, you know, our foreign accents, you know, I'm an emerging markets corporate operator, Julian and Jim. And when we're talking, you know, a couple of quarters or more of, you know, drastic earnings compression, and we're leading to potentially a potential debt contagion, you know, discussion, if nothing else. You know, what do you guys see out there in terms of the currency market? Is it kill DXY to 120, or could there be some problems there in the currency market? Because that's just as impactful on what I do as anything else. Thank you in advance.
Yeah, hi, Ace. It's a difficult one just now. We've seen big implosions already. Sri Lanka's gone. Obviously, Turkey's on the brink. I think there's actually very few in the way of the kind of serious Asian countries apart from Japan, which are on the brink of an absolute currency collapse and economic collapse. So the good thing from a lot of the emerging market side, and I don't cover Latin America, Aces, so I'm sure that's part of your area, but a lot of the big countries in Asia actually look reasonably okay, including China, although our forecast for Chinese growth this year is basically 2% or a bit below that. But that aside, the potential for implosion in their currencies, I think, is relatively limited. The big danger for all of us is Japan, because they absolutely seem to be cleaving to this yield curve control. I could call it stupidity, but that would just be a very light word for the craziness that these guys have got. I mean, I fully expect the Japanese economy to contract about 5% this year, because everything is...
Jim, hold on. That's crucial. Can you say that again? 5%?
Yeah, 5%. Because I think investment's about to collapse, George. I think consumption is going to collapse on the back of real earnings going down significantly. I mean, what people don't seem to realise about a currency like the Japanese yen falling like this, which then raises their inflation rate, which everybody loves, of course. Central banks love it and governments love it, except when it actually starts meaning something about their voters. But when you have purely imported inflation, what you've actually got in the domestic economy is deflation, because you're exporting your currency. And the Japanese are doing that hand over fist at the moment. So you think the Japanese economy was flat on its back for the last 5 years? You ain't seen nothing yet.
Jim, but hold on a second. I know the export intensity of the Japanese economy has contracted. You'll tell me what the number is. So I know they're not as export dependent as they used to be. But you're telling me even with the incredible improvement in competitiveness and the collapse of the currency, you're still looking for a 5% contraction in Japanese GDP?
Yeah, no, absolutely, George. And it's one of the reasons that we're looking for only around about 2% growth in China. I mean, the thing that happened in 2020 that saved people like China, Korea, the North Asian economies, was that America printed shitloads of money. The government deficit went up to what was it? It went up 10 percentage points of GDP in 1 year, and there was a huge amount of money around in Europe and in the United States to buy goods made everywhere else. Of course, they couldn't buy services because everybody was locked down. There was no planes moving. There was nothing. There was no international travel. So they had to buy goods, and that's where partly the inflation's coming from. But what it meant was that Asian exporters and Asian economies really benefited from that. This year, everything's contracting. So even though the Japanese export reliance has gone down, the fact is that there's absolutely no boost to them at all from their export sector. It'll go negative. But there's going to be a massive boost from their import sector because they've got to import much, much, much more expensive goods because their currency has gone down 15, 20% in the course of the last 6 months.
Got it. Just as an aside, do you expect, I think I heard you correctly, I know I'm of the view the yen's going a lot weaker. I know Julian's of that view. Do you share that view, Jim?
I'm torn between thinking that it's going to go a lot weaker and the Japanese are just going to absolutely fall by the wayside. Yield curve control is going to be given up, and the whole facade of zero interest rates, quantitative easing, and this whole period of Bernanke economics is going to be over and done with completely because Japan will have failed, and that will mean that markets will have to realise the whole system has failed. The whole monetary, what would you say, rigging system has failed. The central bank system has failed.
Oh, so allow me my Jeremy Irons imitation from my favorite movie, Margin Call. So, Mr. Walker, what you're saying is, if the music's slow, I'm not going to get it right. You know where I'm going with this, okay? So, Jim, if that happened, I can't do it with a straight face. I got to get my lines down. If that were to happen and they give up the whole facade, and finally, the Widowmaker trade, which has been shorting JGBs for 3 decades, which has never paid, maybe they'll pay. So for $50 in double jeopardy, explain to all of us in the room, what does that mean for sort of global bond markets, given that Japan is the world's second largest bond market in a large creditor country? What would that mean for interest rates globally?
Well, my view, George, is that for most of the last decade, I've been advising clients not to short Japanese government bonds because I just thought it was a bad trade while everybody was at zero interest rates. Today, I think it's the best opportunity globally. Short JGBs. What does that mean in terms of interest rates going up? Much higher, right across the world. And by the way, just one thing on that. I know a lot of people think that interest rates are going to get cut in 2023. If they get cut in 2023, let me tell you, in 2024, they will go up much, much more. Because that would be just making exactly the same mistakes that they made in the 1970s. They cut interest rates into slowdowns. They thought they had the problem solved. But inflation isn't solved by recession entirely. It's got to be solved by monetary contraction. And that's still a long way off. By the way, I don't think many people realise the S&P is still up year on year at the moment. When the S&P is down 20% year on year, then you'll know that you've got an end in sight to interest rate rises.
Jim, it's amazing. It's like tongue in cheek, I put the title from. Well, first the title was Always Darkest Before Pitch Black, period. and then Thornton agreed to come and do the space. So to be fair to him, I was really impressed with myself putting that title up there. I got a lot of kudos for it. I was like, you know what, I'm not gonna take it down, but he's not as congenitally bearish as I am. So I put a question mark after it. So I give him top bill and I put Tom Thornton, period, Always Darkest Before Pitch Black, question mark. Okay. I have to tell you though, listening to Cantro, Julian, and yourself, I'm like, I think that's exactly the right title for this room.
Yeah, but just take the question mark off, George.
Oh my Lord!
Hey George,
oh.
When I saw that, I said to my wife, I'm like, oh shit, George is gonna really want me to go my full bear, and you've known me to be very, very bearish.
I know, but in deference to you, I love you, man. I put the question mark in there. I didn't want you to listen. I didn't want you to do my bidding. You didn't have to do my bidding for you. I can do it myself, but it's just unbelievable how this room. I don't want to say has degenerated. I would say has progressed. Has really been enlightening if I can use such a term to describe the cataclysm that we're looking at. But seriously, these are some of the smartest guys, investment minds on the planet that I pay attention to. And so, Aces, you've been around a long time, right? Or Shrub. You know what? Hold on. Let's get Shrub in here. Shrub's now back up.
Can I quickly jump out? George, thank you for your time. And I wish everyone here a nice long weekend in the US. Happy 4th of July. And it's 7 p.m. here in Germany. I'm going to dinner. And if anyone has any view on Twitter, happy to have a discussion on DM messages. Excellent. And have a nice weekend. Yeah. Bye-bye.
Hey, Shrub.
George. How's it going? Can you hear me well now?
Wait. Hold on. Shrub, are you there?
Yeah. Can you hear me well?
Yeah. Now we hear you. Okay, so Shrub.
Perfect. Okay.
Before we get to the flow data, which is always...
I don't think I can be more bearish than you guys.
Well. Shrub, what I want to know is...
The bar's pretty high, my man.
Shrub, seriously, okay? You got three of the most brilliant... I mean, look at the quality of this panel, right? I mean, you've been around. I mean, you might say, well, it's consensus. No, it's consensus amongst some of the most brilliant investment minds on the planet. And so this is totally out of consensus when measured against the investor class. So I'm going to ask you. You and I like to tease each other. We ask each other questions, and we know they already answers to. What are you supposed to make when you got guys like Walker and Kantrowitz and Julian? And I'm not going to say Thornton. He's not a perma bear. He's a smart guy, but I don't want to tar him with the perma bears, right? When they're coming with stuff like this, I know how it speaks to me. How does it speak to you, Shrub?
So the Led Zeppelin song, the song remains the same.
100%.
It's the song remains the same. It's like everyone just thinks about this V shape and the V shape and the V shape because they've only lived through V shapes. And, no one just pauses to think this can just drag on 2 years like in 2000 or 10 years like the 70s. There's so much excess. And let's have some fun with a few things that you guys touched upon very lightly, that it's worth just adding a few data points. You remember when Cathie Wood saw the arbitrage opportunity between the private markets and the public markets? And she wanted to do a crossover fund. You remember that?
Yep.
So back then I was like, this woman is crazy because Klarna, which is a payments company, whatever you want to call it, or pay now, never pay again kind of bullshit. They were raising money at $45 billion. And back then Square was in the market. Square, which renamed it to Block, collapsed from like 60 billion to 30 billion. I'm like, well, this is insane. The private market is still mispriced. And even then, if you had the D1 mark down their books by 25-30%, then Tiger marking it down by that much because they said, our long only portfolio is down 70, but our privates are only down 30. Come on, man, you're the same team. So anyway, there was a really interesting data point yesterday. So Klarna, they're doing the new round from 45 billion to 6 billion. From 45 billion to 6 billion. This is a company that's in every single crossover family office. It's been peddled to every single company around here. It's the sweetheart of European fintech. So they wrote it down from 45 to 6 billion. That's one data point. The second data point, there's this joke of a crypto company called BlockFi that, anyone with an IQ of above 100 wouldn't invest his own money. And anyone with a finance degree or 1-year analyst in a bank wouldn't invest their own money. They're getting sold for 25 million. The last round was close to 5 billion. Guess who led the last round? Not the last one, the second to last. Tiger Global, 3 billion. So you marked assets. Basically, it was like the absolute Ponzi scheme in the private markets that's unraveling that was holding up actually until the last few weeks. Bizarrely, it was actually holding up because if there's no sellers and there's no valuations. So these guys, the Tiger guys, we sing the headlines, oh, they're down 50%. But I was always saying, like, Tiger, this cycle is going to end with Tiger down more than 70 because even today they're probably down 70, but they haven't marked their assets correctly for the last 6 months. So you're starting to see these big hits, and these big hits are going to basically make a fool out of all these funds, because they're going to be like, if I was an investor, these guys, I'd be suing them. Like, I would have such a field day with litigation. It's like, hold on, you're telling me that in March 31st or in June 30th, you marked Klarna in my books at 20 billion, and now you're doing a fundraise at 6 billion? Or you're telling me that you had a crypto thing at 3 billion and is now worth 25? I'd be like, guys and girls and ladies, we are so early in this redemption cycle for one simple reason. They need to clean up so much shit out of all these guys. And I would, if I was an allocator, I would be embarrassed to be invested with the Tigers after these mismarks, because this is like fundamental. You're not talking about an investing mistake. You're talking about almost a dishonest act. Because, you know, if what's his name wants to get his bonus for Christmas, of course he's not going to mark a Klarna at 20 billion. He's going to keep it at 45 billion. So I think this thing is a major, very important event, subprime equivalent, because when you have mismarks of this sort, this is the subprime thing. It's a confidence thing. It's a confidence thing. And this is like in 08, it was like a confidence thing as well, because you had a lot of banks having things marked at model and marked at model, marked at par, marked at maturity, whatever. It's the same shit. It's just the players changed. So this thing is going to create a confidence game, and that's why you're going to keep seeing the redemptions. Even if the market stabilizes, these guys are done.
Could not agree with you more. You're spot on. Say, Shrub, can you update us on the fund flows numbers from this past week, please?
Yeah, so on the fund flows, it's been something quite interesting. So we've had outflows a week ago for the first time. A decent amount of outflows. And you will see that this week, the outflows were actually, they slowed down. But I have to just make one thing very clear. You guys will see a headline, equities had 5.8 billion of outflows. Bonds again lost 17 billion. But if you break down these outflows, which is 5.8 billion, it's all driven by Europe. So Europe keeps having outflows. It's like bleeds outflows, but actually the US had inflows, and US large caps still had inflows, 6 billion, just significant. So from the flow game, fortunately, it's still the same thing. There's still no capitulation. There's capitulation in certain parts. So I think credit, there has been some capitulation. You had, for every 100 that came in, 35 came out. Even if we argue that, credit still has more to go, there's still, there's been significant outflows in credit. But in equities, the flows have been neutral over 4 months. So over 4 months, we've had flat net inflows. And in the US, if I break it down, it's actually probably still inflows. Now, there's one little interesting point to make here. 3 interesting things. Financials had 14 weeks of outflows. I think that's not a surprise. But resources, they had their largest outflow ever. I thought that was very, very interesting. So you had materials out 3.5 billion and energy 1.3 billion. I think it's a very, very interesting data point that that you've actually seen capitulation on the tourists in the energy space. So that's why I think it's been a very fast decline. I mean, we've talked about it 2 weeks ago. The decline was very fast. 25% drop in the XLE is it's the biggest move, I think, ever in terms of speed. And that shows in the outflows. So I'm actually quite, I'd be more comfortable. I think it was Kantrowitz said, be more comfortable, being on the energy side than something else where you have like a cleaner setup at this point.
Yeah. So Shrub, let me ask you. Hold on. Let me ask you, Shrub. So you were cost on energy. I was cost on energy. Aces was cost on energy. So I just sold my longs, and Aces did the same, and I didn't go short. I think you went short. But my question to you is, so like I have no energy, and I'm kind of wondering, because we also believe in the long-term theme. I'm not comfortable getting back in just yet. I mean, I get it's going to outperform the other stuff. I get that, but like right here, right now, if you were to come down from planet Mars, and psychologically you're not impacted by your prior victory or failure, and past results are no guarantee of future returns. If you were going to put a trade on, you're like, you know what? Don't talk to me about hedging. Don't talk to me about being long energy versus the S&P. Just up or down, red or black. If a friend said should I be buying energy stocks here? What would you tell them?
It's a very tough call because if we're, it's the same thing as 2 weeks ago. We're bearish the economy, and energy is gonna get hit. But gun to my head, I bought some of my energy exposure back. I bought my safe royalty plays that give me a nice dividend. I told you I bought the fertilizers, and I'm down 10% already. And the fertilizer should be much less GDP sensitive than energy, and that's down 10% on me. So, I kind of feel like I want to have some exposure to energy, but I would have half the exposure of what I would like to have. Because the reason I can say this is because I'm 60% cash right now. So I'm okay to have core convictions.
I'm actually really glad you said that, because there's a tendency sometimes on Twitter, this, someone will take something that somebody else says out of context, and they'll say, oh, Shrub was bullish on fertilizer, Shrub was bullish on energy, he must be getting fucking destroyed, excuse my French.
But
the reality, but the reality is, if you're 60% cash, you have the right, you're comfortable, it's not a big exposure for you, as opposed to you get some of these folks on Twitter here, and they're putting like leverage positions with call options on and this and that, and it's a totally different picture. So it's important that people understand the context of what you're saying. But like you,
exactly, and to be honest,
yep. Go ahead.
No, exactly. I think it's important to clarify. We've been saying the cash position for the last few months. I think that remains. You need to have a very big cash position, and to be honest, I'm going to stop loss. I'm not in love with anything. I like my old boss used to say, just love your wife and your kids, but don't love your position. So, you know what? If I see weakness, I'm out.
Yeah,
I'm
100%. So, Ace, sorry to cut you off, but I just want to get that question. Aces, back to you. Aces.
Yeah, no, I just wanted to say, Shrub, you left out my favorite one, Mark to Myth. I'm just curious, right? That's what we got. So I'm just curious in terms of the Fed. I think they were they basically really didn't roll anything off from what I can see. And also there were some rumblings about the mortgage market having some problems. Have you seen anything there? Any opinions there?
Yeah, so there was one argument that it takes a few months to settle, and I really want to look more into that on the MBS side. I don't know if anyone has any view, just please raise your hand. But look, my view is the liquidity in the credit market was so bad before the QT. We've highlighted this early on, I think. There was literally no liquidity in the equity market. And there was a Bloomberg article today that Allianz said they take weeks to unwind a liquid position, and they can't even buy something. They can't buy new positions because the liquidity is not there. So they were going, Allianz was actually just raising the alarm that there is no liquidity. Liquid stuff takes them weeks to buy, and they can't get in new positions. So the liquidity problem has been an ongoing problem, which got worse and worse and worse. The reason why no one has been banging the table about it is because things were going up. So, all these Volcker rules and all these things that just drain liquidity and have left banks with no inventory in the credit market, no one cared because, bonds were rallying through the roof, and Austria was issuing 100-year bonds at 1%. But, now it's time to pay the bill. And unfortunately, I actually don't believe that the Fed is going to manage to do QT. I don't believe they're going to do it. So give them a few months, but I cannot see this sustaining.
So there was a time, Shrub, when you thought a clever move might have been for them to back off on their rate posture and put the pedal to the metal on QT. You don't like
Correct.
that idea anymore?
No, I
moved
like
off on
it
that
because, look, I like it because it's the cheap way of doing tightening. I mean, you want to tighten financial conditions. And think about it this way. You have a very liquid market and you want to bring it down. So if you're a seller, it's a great way to increase financial, to tighten financial conditions. So I still think that was a smart thing to do, and they would have ended up having fewer rate rises and just smash the smash the credit market, and then you create you artificially create a recession. But having said that, because now we're entering the recession talk, we're kind of far in the game. We're like 6 months down the line, or 3 months down the line since then. I wonder. And since then they've done 75 and they're doing another 75 most likely. So by this point, you're talking about significant tightening. And if they're selling into a liquid market during the summer, I don't really know how long they're going to manage. I really think that I wouldn't be surprised if they stop before Christmas, the QT. I don't know what you guys think, but I would struggle to see how they do it because you also need a buyer on the other side, right?
Thanks. George, you go to Thomas next. Tommy?
Hey guys. Do you happen to notice there's a couple things that hit the tape. Exxon guided up. They put an 8K out and guided up over the weekend. And Tesla just came out with their delivery numbers, which missed. And they missed, not much if you look at CNBC, because CNBC, any number is good number. And just keep in mind, not many people will, probably Tuesday, because they'll buy it. But they guided the Tesla IR had all the analysts guide down their numbers huge. And they put a consensus out that was about 30 to 40% lower than the analyst. And I think it's important, though, the company that's making more money than God just is going to be making more money than God did before. So it's kind of interesting to see that Exxon release. If you can look at it, I think it's pretty substantial.
Tommy, Tesla's been doing that every quarter for years, which is a direct violation of Dodd-Frank. They privilege a very small number of investors with that sort of thing that they do, where they guide everybody to a number, and then all the previous estimates come out of Bloomberg, and then they beat and beat and beat and beat and beat. They've been doing it for years, and it's criminal. Thank you and I saw what you said on your timeline about your previous employer, and it's unbelievable. George sounds like he may have stepped to the restroom or something. Let's go to a couple of hands. Jake, you've been sitting there for a while. How you doing, buddy boy?
Doing good. Hey, appreciate it, Aces. Great spaces, guys. I think it was Julian speaking to the multiplicative effect of like the QE and QT inflation cycle against volatility. Just curious if the kind of increasing pendulum swings of regulation and deregulation in the American political climate, as like it seems like we go further left and further right, could act as almost a cubing factor against that volatility.
I kind of, it's the period that I've been looking at, as I said, is the sort of late 60s. And I think we're falling into all of those sort of steps. I mean, in the late 60s, we got guns and butter. We did get the Johnsons, Great Society spending, because we kind of swung too far, and social justice was too unbalanced. And in many respects, what Biden tried to push through was quite similar in that sort of respect. So the politicians, the thing that I worry about for the politicians is they will always pander to the last threat. Fiscal rectitude has been taken out and shot through the forehead. And so if I try and align the dots and I said, okay, look, we're in a recession, it's early 23, we've got an election coming up, what are the politicians going to do? Are they going to stick to the fiscal rectitude, or are they going to try and spend more money to get elected? And I was at a dinner a few months ago where I met a Republican representative, and I posed that question to him, and he wryly smiled and he said, well, we'll spend more money. It just depends on what, right? So I think that actually politicians, this is what happened in the 60s. You had a central bank that just got out of whack because, inflation started to pick up in 65. They hiked aggressively. The equity market rolled over. They then eased aggressively, but they eased into ongoing fiscal spending, and then it reaccelerated inflation. It never went back to the prior lows, and we went through that cycle on three other occasions. And that's kind of where I think we are. So I'm actually thinking that the political cycle adds to the vol and adds to this risk of boom bust, because fiscal rectitude is now, it's gone. It's gone. And we live with such a, if we think that corporate executives manage to the next quarter and their stock options, essentially politicians do the same thing.
Thanks, Julian.
Nice. Jake, I'm going to have to put you down because I've got about 8 or 10 people who want to come up. Hey, Preet, I've seen you came up about 15, 20 minutes ago. Did you have a question for one of the experts?
Yeah, sure. Thanks. I think one just point of clarification on the endowment foundation side, someone made a comment about private equity. I think the one thing to note is, a lot of the endowments foundations are diversified across different assets like energy, like biotech, tech, other sectors like industrials. So, there might be some endowments improperly positioned, but I think from what I know, at least, a lot of them have a lot of diversification, even on the privates. That said, I had a question on, I think the topic being discussed was the CapEx was bad, companies with inventory, that's going to be harder. So, in terms of sector, and energy is a special case in terms of CapEx because there's other sort of structural, supply issues that will make it attractive. But in terms of, things like software and biotech, where the CapEx is low and you don't have these inventory issues, I'm curious what the speakers think of that for, call it the next 5 years. And you sort of have an opinion if these things get to reasonable valuations, whatever you may consider those to be.
Yeah. Let me interrupt. What is the question, please?
So that's the question: is are those two sectors attractive, biotech and software, over the next 5 years?
No,
Aces. Let me take this. I want to move on here. I think both those sectors are both incredibly unattractive. It's not a question of CapEx; it's a question of long duration assets, and they've been the eye of a lot of speculation. So I think they're a complete disaster. I would run, not walk, as fast as possible away from those sectors. Aces, I'd like to maybe go for another 10 minutes and then call it a day because we've been going now for almost 2.5 hours. Aces, you've been running the room. Who do you want to call in here? Just a few more questions, and I want to call it a day.
Our favorite pain in the ass, I think, is next. Hi, O'Hare. How are you?
What's up, guys? I just wanted to ask you, excuse me, I'm suffering from COVID here. Unbelievable all week. The discussion about private equity and venture capital investments on the part of foundations, endowments, that's one thing, but it's the big pension funds out there that are just chock full of this stuff over the last 5 to 7 years. They've been going out of their energy investments and putting all that money into private equity. And it's interesting, CalPERS is coming out with their annual report here, I think in the next few weeks. If you go to their report from 2021 and you go down to the breakdown of investments, I mean, they are just full of private equity and private real estate investments. So, if you think that the hedge funds like Tiger Global, among many others, are having problems marking these things, and somebody a long time ago coined the term mark to make believe, these guys, it's like a linear return for them, right? It's like George has said many times, and like some of you guys, it's just it's a wonderful way to just keep fees coming in because it's just straight linear left to right. So my issue is like the unknown in the pension fund space, because I can tell you, as bad as it is for the hedge funds, these pension funds have put in tens, hundreds of billions of dollars into this globally. I mean, it's going to be a disaster.
Couldn't agree more here. I mentioned CalPERS about an hour ago and talking about
Oh, did you? Yeah, CalPERS.
So,
I mean, if you look at their report, it's amazing.
No, going to be a disaster. Pour yourself a stiff scotch before you read that report. Appreciate the comment. Let's move on. Hey, Rob, good to see you. Rob is a good friend of the room. Rob, what's on your mind, man? Rob Isbitz, what's up, Rob?
Oh, hey, thank you so much, George. And first, a very quick apology. I had a steam contributing to this thing for the past month. I love it. It's the best crowd ever. And in the last month, all I've done is start a charity, start a bond replacement project, say goodbye to my mom after 7 years of Alzheimer's, and put a cat to sleep. So I have a lot to add to the group, and I'm working my way back. So
I'm really sorry for you, Rob. I always love hearing from you. I'm sorry for your loss. So
no, it's okay. It's okay. And we're about to leave for 3 weeks in Somerville, Boston area. And if there's anybody from this group who wants to get together and talk markets, just ping me. But for now, a couple of quick thoughts for you guys to react to. And this is, coming from my former world, the advisory space, and just some of the crazy shit I see going on there. Most of it not good. First thing, this is a nickels and dimes market. What do I mean by that? Up 5, down 10, up 5, down 10, wash, rinse, repeats, like death of 1,000 cuts. The public is not ready for it. When it accelerates, it's going to accelerate. Just a matter of when. And financial advisors and pension funds, that's why I'm glad I followed the fellow just talking about pensions, totally fucking unprepared. So the second thing, and the last thing really, the cycle of market emotions, we've all seen the chart. I have an emoji version of it myself out there on the web. We are still much closer to complacent than despondency, I say, as an amateur sociologist. And so the bottom line for me, and I'd love to get reactions and questions to this in the few minutes we have left. S&P is going to drop below 3,700 at some point. Next stop, right down to 3,200, and after that, maybe it's 2,200 or maybe it's 2,000, because this is what markets do. This is what cycles do, and this is the cycle and the bubble to end all bubbles. When it doesn't matter, you just have to have a plan, and that's why this group is so great. So let me stop there. Glad to be back after a hiatus. When listening to the replays, reactions, questions, and thank you all for listening.
Hey, thanks, Rob. I'll just go first and then anyone else. Couldn't agree more. For the average person in the room who wants to know what to do, I keep saying the same thing. You mentioned defense. Have a lot of cash. Be like Shrub. Have a lot of cash. If you've got larceny in your heart, you're not comfortable being short. Go short. We had the everything bubble. We're not having the everything bear market. It's always, remember, don't fight the Fed. Well, yeah, don't fight the Fed on the way up. Don't fight the Fed on the way down. It's pretty simple. So, it's summertime. You're just going to lose money the next few months in the market. Just go to cash. Go enjoy yourself. Hug your kids. Go to the beach. Come back in the fall and we'll see what happens. But for now, I don't think you're missing any of the upside. Again, for me, equities continue to offer return-free risk. I don't know, Julian, Cantro, O'Hare, Walker, anyone have
George, one thing I would just say to that in closing, I completely agree, except I'll take it one step further. The first thing you do with a bear market is you defend against it. And the second thing you try to do, if you're willing, as you said, is you exploit it. And that means net short, but renting instead of owning. And I'll talk about that more, I'm sure, through the summer. So thanks.
Anyone else on stage want to? It's a great question. Anyone else on stage want to answer that one?
Well, I would just say, I think a couple places you can kind of hide out, and I think it's just from our perspective anyway. Everybody's got an opinion, but I think energy and some of the consumer staples names. If you want to be in stocks, if you want to hide out, that's one area. A couple areas I would look, and even the materials names. Some of the fertilizer stocks, for instance, are great bargains right now. So there are areas that you can look at, from a maybe a 2 or 3 year perspective, with the idea that they could go a bit lower. But if you want a place to hide out, those are some of the places I would look for.
Thanks, Sawyer. Right, Tommy Thornton, you still there? I know Tommy's still there. All right, let's go on a couple more.
Yes. I'm here.
Yeah, Tommy. If someone's bullishly inclined, scalping or otherwise, like, what are the parts of the market look best to you? Be it, if not on an absolute, on a relative basis, like where would you be hunting?
I've been sorry. I'm just walking in and out doing a barbecue. I think you can start to come back into some energy names. I think what Shrub was saying is spot on. I think that you're going to see some bounces there because there's still going to be some really good earnings going forward, and so I think the market will respond better to those, even with some of the commodity shakeout. I think you can be there. I'm starting to look at some of the materials as much as it looks awful. I'm a little bit more nervous on tech. I'm very nervous about financials. Industrials are sort of a no man's land right now. Biotech, as much as everyone hates biotech, Helene said last week there are no charts with bases. Well, biotech has a base, and I think that you could see a mean reverting bounce there and nobody will really notice. So I'm kind of looking around those areas, but just with everything, I will scale into positions with a small size and scale out of positions. And I hope to be taking profits, smaller profits in this type of environment. And I'll take profits early and maybe too early. And if I see things change, I'm out. But that just worked well tactically through the whole year. And that's kind of where I'm at right now. You're
better. You're in a rental mode. You're not looking to buy anything.
Yeah, I don't see anything that looks, jumps out at me and says, well, this is a safe risk reward here. Right. I don't think that's even in anybody's vocabulary right now. So I think right now it's just, you're going to look for places with relative strength that's starting to act better, maybe build some basis. I'm long some China stuff, Alibaba, K-Web, stuff like that. And those have done really well. But right now it's such a nasty market that you could be expecting something a little bit more, and if it doesn't work, just you got to be out. You got to be willing to make mistakes.
You're right. By the way, Tommy, I'm going to put this one at you, and Aces. I don't want you answering. Well, I don't know if anyone has any answer. I mentioned rental versus buy. We haven't really talked about it, but I don't want to open Pandora's box. But if anybody on stage has any views, whether it's Rob or Bob Klein or Julian, anybody. Bloom is off the rose. I mean, it can change the margin. Someone asked me, like, what's changing now compared to what's changed now versus, say, 30 days ago. Signs of real slowdown overall real estate markets. Admittedly, we all know real estate's a very local business. And so not every market's the same. But generally speaking, you look at inventory levels, you look at percentage of houses where asking prices are being cut. I just think, consider the anecdotal stories I'm getting. You look, that game is ending, and so I think, I think we're looking at a pretty real estate market's only be a source of negative surprise going forward. The other thing I would say, and there was a great video. I put it in my Twitter feed. It was a YouTube thing. It was like a week ago. This guy in Aces, I don't know if you saw it, but this guy out in Las Vegas did a really good video on what's happening to the repo market for automobiles, and how the last couple of years there was a dearth of repo cars that came on the market because I guess moratorium on repossessions, and now that's gone away, and so the number of repos that's occurring is like double or triple, some crazy number like that. And the guy was taking around Vegas, showing you these tours of these parking lots of all these used cars that are being repossessed. And so, everyone's the great cocktail party conversation the last couple of years has been, look at used car prices. Well, there's reason to think that if that's right, and again, I urge everyone to go look at it. Look at my Twitter feed. I put it in there a few days ago. It looks like the used car market might even be for tumble as well. So whether it's real estate or it's used car prices, I think that's going to those will come front page stories before too long. So I don't know if anybody on stage has any input or insights to any of those observations.
Yeah, George, may I offer a quick metaphor?
Please.
All right, yeah, and this is as a 42-year technician. There was a time where when I'm staring at thousands of charts a week and trying to make decisions tactically and long term, my go-to was the weekly chart and maybe the daily to make final decisions. These days, everything is in play from probably 30 minutes all the way out to the weekly. And I spend more time on the 1 hour, the 2 hour, the 4 hour. And why is that? We just saw it with this most recent rally, which I thought had a chance to maybe go another 3-4%. And then bam, it just stopped. Why did it stop? Who the hell knows? All we know is that it stopped. And it's probably because of all the things that were being discussed here about flows. And it plays itself out. Like I say, market always tells us a story. We just have to listen. And that's what I hope to contribute here through the chart work. But, it's just we're getting into an era where even the stuff that the chartists and the algos used to use to be successful, at least for now, it's done. And when it comes to past performance, which a lot of these guys are trying to live off of, the only past performance that I think really matters is what you're doing this year and going forward, because the rest of it is just all changed.
Yeah, Rob. So brilliant insight. I don't think you were in the room earlier, but we had Tom Thornton kicking off the room, and he spoke to how he's been looking at a lot of the 60-minute charts.
Mm-hmm.
Really, really helpful, and I thought that was particularly noteworthy from Tommy. So great minds think alike. You and Tommy are on the same page there, so I couldn't agree with you more.
Thank you.
George, I just put the video with the car guy in Vegas in the nest.
Thanks for that, Aces. Thanks. That's awesome. That's awesome. All right, let's get through a couple more here, and then we're going to close the room. Let's go to Andreas. Try to keep it, please. If you have keep it tight. If there's a question, don't want any speeches because I want to close this room down before 12. Go to Andreas and then Oilman. Andreas, welcome. What's up?
Okay, thanks, George. I'll keep it real tight. So, like everything we're talking about, market's going down. QT is happening. QE is gone. So, my one question to you, so it's real theoretically, in your opinion, so as we're in a QT cycle that just started like 2 weeks ago, have you noticed a backdoor in the reverse repo market through the percentages for those days, which is really high if you really look at it?
Okay, stop. Andreas. I have an aversion to all this fixed income market plumbing discussion because I'll tell you flat out, I don't understand it. And I think
I've been trying.
Hold on.
Yes, man.
Aces knows what I'm talking about. There are people that run rooms. All they do is talk about that stuff, and it sounds great, but I listen to them, and the lips are moving, but I don't know what the hell they're saying. So I don't like to go down that rabbit hole because I don't understand it, and I've yet to listen to anybody explain to me in plain English that I can understand what it all means. So I don't know if there's some plain English question you got and somebody on the stage wants to answer it, that's fine.
Why is the Fed balance sheet going up when we're doing QT?
Okay, fine. All right. Oh, now we're talking, okay? Watch what they're doing, not what they're saying.
Nice save, Andreas.
Kick save. Hey, Walker, you want to answer that one, dude? Walker.
Where's Jerry Chivas?
Or Eddie Jockman, kick save and a beauty. I don't know. Julian or Walker or any other number crunchers want to answer that question? I mean, it's all bullshit. These guys lie as much as they can. Watch what they do, not what they say. But I don't know, Julian or Walker, anybody have an answer to the specifics of that question? If not, we're going to move on.
I just don't think the Fed knows what it's doing, George. It's day by day. In fact, it's probably brought back to what Rob's saying. It's minute by minute, and they haven't got a clue what to do if it was anything strategic whatsoever.
Jim, let me use this question. This is for you and for Julian. Like, you look at I can't remember who made the point. I can't remember maybe Julian, was you, I think, a week ago. I think it was you, Julian. I don't want to accuse you or give you credit for this one. Even if you didn't say it, you should take credit for it. I think it was you making the point that, Jerome Powell will go down in history perhaps as the worst Fed chairman ever, making two incredible, incredibly bad policy decisions in the course of 12 months. Now, whether, Julian, you said that or you didn't, and or Jim, if you want to answer it, I mean, Julian, Jim, or anybody, Julian and Jim, you two guys, how would you respond to the assertion that Jerome Powell should be nominated for the worst Fed chairman in history? Jim, what would you say to that? Or Julian?
I think they're all pretty bad. I hate to say it. I think they are public servants at the end of the day. Their approach to data watching is, I think, archaic, given the data that we've got. They try to improve. You can see that in some of the regional stuff. I have a very good friend who I think sums it up well. He was Senate chief economist. He worked for probably one of the top 3 macro hedge funds as, let's call it euphemistically, chief information officer. He worked at the Fed, and he says, quote, "I've followed the Fed, man and boy, for 45 years. They're always most bullish at the top, and they've never called a turn." And I think that's the case. And I think, given their job, I'm not blaming them, but that's why I think they're going to add to this volatility going forward. And this hawkish pivot was necessary. But when you've bumped up asset prices to this degree, and you have the feedback loops that we do between financial assets and the real economy, you better strap yourself in.
Yeah,
Julian,
I don't fault them for doing what they're doing now, but I never had anything good to say about these guys. I go back. My favorite example was when in the great financial crisis. I'm curious what you think of this one. You may have made this one up too. I don't know. I just repeat things that other smart people say. And the analogy was someone was singing the praises of Bernanke or whatever, and he saved the system and all this sort of nonsense. And I was like, come on, dude. It's like the drunken school bus driver who drives the bus off into the ditch. The bus overturns, catches on fire. There are, children trapped inside. He manages to get all the children out, and people are lauding him for his heroic efforts. Question: who drove the frickin' bus into the ditch in the first place? I mean, it's just outrageous, and they're never held to account. I think started with Greenspan, from Greenspan to Bernanke to Yellen to Powell. I probably missed somebody. I mean, the song remains the same. How either Jim or Julian, how would you respond to that?
Yeah, can I just say something about Powell, George? I think he's the schmuck that's going to take the hit for what Bernanke started in 2001. It goes back to that point when he basically, after 9/11, took interest rates to 1%, which were the lowest that they'd ever been, and then fueled the property bubble, which he blamed on the Chinese, but now we know that he fixed the actual research that he blamed it on the Chinese on. And then he introduced quantitative easing, which is what he wanted to do for Japan. So he's actually done one thing, is ruined Japan. That's another one on his list. But he is the guy who has caused all of these problems. And everybody listened to him because he was a student of the Great Depression. The unfortunate thing was that he didn't understand a single thing about the Great Depression. And as a student of the Great Depression, what he managed to do was basically be a student of Keynes. So print money, get governments to spend it, and everything will be okay. Well, I'm afraid for centuries we've known that that's absolutely wrong. And he's the guy. He should be in jail, and he should be in jail for the rest of his life.
Jim, you and I know going on way back, and you haven't changed at all. I love you. I couldn't agree with you more.
George, if I want to just add, just completely concurs with Jim, but it's an amusing little anecdote. I was at a meeting where Koch Lakota spoke, the Minneapolis Fed president. It was a very, very small meeting up in Vail, and I asked him this question about QE and asset prices, and he sort of avoided it while he was on stage. And then afterwards, it was one of those classic things where everyone's too embarrassed to speak to the speaker, while you're having a drink afterwards. And I walked up to him and I mentioned a mutual friend And he completely opened up. And I said, well, okay, sir, well, would you mind answering the question? You know, if QE is just about liquidity at the front end and it doesn't influence asset prices, why is it that when you start it, asset prices rise, when you end it, they wobble, they fall? You know, explain this. And I am not joking, ladies and gents. His index finger came out and he started punching the air. And he said, it's Bernanke's fault. He started this idiocy and we have to keep going until we can't stop.
Julian, you serious?
Yeah.
How many years ago was this? How many years ago was this?
This is probably 6.
Wow. Thank you for that, sir. All right, couple more questions.
Completely concurs with Jim. Completely concurs with Jim.
All right, let's do a couple more questions, and then I'm not gonna allow any more people on stage. Everyone on stage hasn't asked questions is going to be able to ask, but that's it. We're gonna do oil, and then we're gonna do Glenn. Oil, what's up, man?
Hey guys, great space. Thanks for having me. I was curious, when this bloodbath truly starts, do you believe they're going to bring back the eviction freeze in multifamily and everything else? And also, what's to keep them from printing money again when all this shit goes to shit? Just my 2 questions for you guys. Anybody had thoughts?
Yeah, I don't know. I mean, listen, I think ultimately, who knows where this is going to go. Desperate people do desperate things. So I wouldn't put anything past these guys. I don't know, Julian or Jim, you got any views on what they're likely to do when this shit really hits the fan?
I think they'll do what they did in the late 60s and they sacrificed the dollar. So, you know, I think we're going to hit this point of the impossible trinity, which is the terminology for the inability to control, the ability to only control 2 of 3 metrics. And I think at some point, if the pain gets sufficient, and they're forced to look between the bond market, the equity market, and the dollar, they'll probably choose the bond market and the equity market. Those are the 2 logical ones to choose. And the net result will be, I think, a significant drop in the dollar. But yeah, I mean, it's going to take, you have to go through a lot of pain to get to that point because it's a very unpleasant thing for them to do. But that's where I suspect we're going to go, just like we did in the late 60s, which led ultimately to the collapse of Bretton Woods. And that will kick off, I think, the next big wave of the inflation story, but we're not there yet.
Hey, Julian,
baby, gold,
yeah. This is for Julian and Jim. I mean, we all know the reasons why the dollar's doing what it's doing. I mean, it's been tough to call, but whatever. You know, cleaner shirt and the dirty laundry, debt deflation, all that stuff. But all right, Julian and Jim, isn't the dollar pretty overvalued by most measures that you look at nowadays?
Totally, George.
Yeah,
and I completely agree with Julian. I think that's what we'll give eventually. Unfortunately, I've been far too early on it. We've had a short on the dollar index. But the biggest problem now is that most other central banks, I mean, I can't remember who it was mentioned earlier. Maybe it was Tom was talking about,
hey, George,
I think it was maybe Julian talking about the Sintra thing, the meeting of Bailey, Lagarde and Powell. I mean, you couldn't get 3 bigger jokers together. And this is a big problem, that what's going to rise against the dollar? Because it certainly ain't sterling, and it most definitely isn't the euro. And that's the real issue for the Americans. They've got themselves into this bind. They've got themselves into the problem of how do you stimulate the economy after everything else doesn't work? Well, the dollar should fall. But what does it fall against? I mean, it possibly is emerging market currencies. It's certainly the renminbi. And 3 Aces will love it. It's definitely commodity currencies, the precious metals. But the real issue here is that Bernanke's sickness is right around the world in terms of what he's done to central banking and to economic policy making. They're all dire.
Wow. Just wow. Aces, or Tommy, any closing thoughts from you before we close this?
No, thanks, George. Absolutely another masterclass of a spaces, and hope everyone has a great long weekend. and a safe holiday. Take care.
And Tommy, I want to thank you again. Huge, I value our friendship and the public service you provide by coming in these rooms to help everybody. Appreciated by all. You're one of the most popular speakers in these rooms. Must be your scintillating personality. I'm reliably informed that people like you more than they like me, but that's okay. I love you anyway. And by the way, Tommy, I have no commercial relationship with hedge fund telemetry, but do follow Mr. Thornton, and I suggest you read his service every day. And it's one of the best things you can get out there, and the price is unbelievable for what you get. So reach out to Tommy if you're interested. Julian, I want to thank you for your contribution. It's brilliant, and really wonderful that, I don't know what it is, it's the guys over in the UK or Scotland, whatever. You guys always sound smarter. Maybe it's the accent. I don't know if you are smarter, but actually you're in the US now. I don't know if you are smarter. You certainly talk a good game, but I really, really thoroughly enjoy your inputs, Julian. I'm glad you came into the room. And Dr. Jim, always a pleasure. This has been fantastic. I hope we'll do this again before too long. I gave it a rest this past week, but there's always, who knows what we're going to talk about. Each week, each day, each week, something crazy comes up. We're never sure of things to discuss. You guys are like nuts. I mean, you guys' this room's almost 3 hours long. My partners tell me I got to limit these to 2 hours, but it's like I can't do that because there's too much good stuff to talk about. But don't worry, we'll do it again. All right, listen, Aces, thank you. Thanks, Rob. Thanks, Bob. Thanks, everybody. This has been great. We'll do it again, and take care. Enjoy the weekend. Bye-bye, everyone.
Thanks, everyone. Thanks, George. Bye.